The Fed have laid out their course. They're going to be hawkish. They're going to continue doing what they're doing.
Dollar strength at the moment is helping the U.S. inflation story.
You're saying inflation in the United States still increasing. It's going to be a real problem until the Fed gets their arms around the demand side.
The Fed is very much committed to raising rates.
Eventually, the Fed usually does win out in the form of slower growth and eventually a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Who came up with today's schedule? Live from New York City this morning. Good morning, good morning.
Boy.
For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. TK back in the seat with futures unchanged on the S&P 500. Tom, coming up, an ECB rate decision and Chairman Powell speaking somewhere in that news conference.
Somewhere in the middle of it. And I got to admit, John, I'm very surprised by this. I think just on a courtesy basis, you don't step on each other.
Couldn't agree more.
I don't know who's on fault, but, we're going to do our best to cover it. And really good news is Maria Tadeo
making a
sighting
comeback
in Frankfurt.
I saw that. Very cool, Tom.
Yes.
On a day we're talking about a 75 basis point rate
Yeah,
hike.
come on.
50, 75. I'll say this, maybe just a little bit of a difference on the executive board over at the ECB.
Right.
Philip Lane perhaps leaning towards 50, Schnabel leaning towards 75. Interested to see how that works itself out a little bit later, Tom.
John, I took a one-day sabbatical here. I had afterthought. We went back to the school, Our Lady of Perpetual Tuition. And I got to say, John, I did a lot of reading over the last 48 hours, and I'm on the warpath that Europe is the same as America. It's not. And it's not just the war in Ukraine. Christine Lagarde has a near zombie economy since 2009.
And you needed to read the last 48 hours to work that out, Tom.
Well, no, but
Who
it just
thinks
accentuated
that the ECB
it.
faces the same problems as the United States right now?
Well, I'm just saying I think there's a generalization here of looking at real GDP and that. The animal spirit, I sound like Michael Darda, the animal spirit that's out there right now, and it's my chart of the year, is that Europe is deceptive. They had a boom, John, that you lived before 2009. They've basically flatlined since 2009. 75 beeps in Europe is not 75 beeps in America.
They got an extra crisis in the middle of the last decade, and they're running into another one and another one. And Lisa, this one, it's about energy. The price of energy, the price of gas in Europe, and what it means for the economy, what it means for this ECB.
Which is what you're seeing reflected in the euro and the fact that you have seen it continue to decline versus the dollar, albeit with a little bit of chop over the past few sessions. And Kit Jukes coming out this morning of Societe Generale and saying it almost doesn't really matter how much the ECB hikes rates, because we're talking about a fundamental outlook that's pretty negative until there is some sort of conclusion or certainty with energy prices, with Russia's war in Ukraine.
But the ECB hiking, Federal Reserve hiking, Bank of England hiking, RBA signaling that maybe they downshift at future meetings, and a BOJ talking some verbal intervention, Bramo, and seemingly achieving absolutely nothing
so there was
in the FX market.
Yeah, there was this meeting of officials, of Japanese members of different agencies to talk about the concern in the violent move in the yen that they were saying was not justified by the fundamentals. Everything remains on the table. They are looking at this. It's concerning, and the yen is still weaker on the day.
The yen is weaker. Tom, verbal intervention is not getting it done. When you've got a cap on your yields in the bond market and everyone else is hiking and you're not.
What upsets me, and I thought our article was great off our Tokyo desk, John, what upsets me here is it's so blatantly clear that the constraint is the illiquidity within full faith and credit Japanese bonds. This is a fiction. It's a fictional theory. And the bottom line is what we need to do is study the illiquidity of Japanese bonds. That will be the tip point for BOJ.
The JGB market is not a market. I think we can all agree on that.
It's a fiction.
Futures unchanged on the S&P 500, on the Nasdaq 100 right now, unchanged as well. Going into a conversation about the ECB and Chairman Powell. Bramo's going to go through the times and dates in just a moment. Yields are lower by 2 or 3 basis points, 323.70 on a US 10-year. And a euro, Lisa, just slightly weaker, 99.93 on euro dollar.
Tom, when you say that, I think about the back-to-school moment that we're in, and it seems like once upon a time there was a Japanese bond market. It was a fiction, would be a good way to start. Today we do have the ECB
ECB rate decision at 8:15 a.m. The Christine Lagarde press conference is at 8:45 a.m. Yes, it is awkward timing. We will get to that in just a second. The euro has continuing to slide, albeit with a bit of chop. How much can they give some sense of how much they look to energy prices? How much they're going to look to the speech that we're expecting from Liz Truss later this morning on energy, on the plan to support that, on the European financial leaders coming together tomorrow to discuss this? How much is that really what's driving the rate moves, what's driving the euro? And frankly, how much are the hands tied of members of the ECB? At 9:10 a.m., this is why it's awkward. Fed Chair Jay Powell is participating in a moderated conversation with the Cato Institute, conflicting with Christine Lagarde. How much can he really give insight at a time when the market is pretty much pricing in a 75 basis point rate hike for the U.S., for the Federal Reserve later this month? As Citigroup said, it is the summer of 75 basis points, the summer of 75, and that does seem to be how it feels, perhaps, with the Bank of Australia a little bit on the borders there. We're also hearing other Fed speak today, so it's not just Jay Powell, though he is the headliner, obviously. Charlie Evans and Neil Kashkari speaking later today. And then, interestingly, around 2 p.m., we hear from someone who we have not been hearing from. And I find this fascinating. U.S. Treasury Secretary Janet Yellen, who seems to have been hiding amid all the discussion about new proposals, about gasoline prices, about how to deal with the greater inclusion of coal around the world. She's going to speak about green energy. Does she give any insight into inflation? And she was one of the big proponents of transitory. She backtracked. What does she say now, John, at a time where it seems global and it seems protracted and it seems like it hinges on things very much out of central banking hands?
They should reschedule that and do it at 9:20.
9:20. Why not just leave it at 9 a.m.?
Squeeze it in.
You know.
They should all do it at the same time. And with Tom on this, just briefly, the ECB pushed back their rate decision to accommodate US economic data, Tom. And then the chairman schedules an address in a really important news conference. I know this is a small issue and we don't have to sit on it for too long, but Tom, I don't think that's the done thing.
I just think there's protocol, there's courtesy, there's nicety to it as well. To me, it's just flat out graceless.
I'm with you, TK.
I'm sorry.
Alsa Linos joins us now, Global Head of FX Strategy at RBC. Alsa, I'll let you skip that question and let's get straight to that decision, 8:15. What are you looking for?
So it's going to be interesting. Obviously, market very finely balanced between 50 and 75. I think the consensus is certainly leaning towards 75, but we're still in that 50 camp, or at least our economists are in that 50 camp. But from the point of view of the currency, I'm not sure it makes a huge amount of difference, because really what everybody will be looking for is the press conference and what signals, if any, we get on the terminal rate and the discussion around neutral and how far to or above neutral we need to go.
Elsa, can you measure neutrality for Christine Lagarde in a disparate Europe? You've got 17 nations or 20x nations. Is it even possible to find the neutral point?
You're absolutely right, Tom. I mean, it's very difficult at the best of times. I think, even in the US and Canada and the UK, central banks struggle to precisely pinpoint neutral. It's particularly hard at the moment because we think about neutral as really being a combination of a real neutral rate and then inflation expectations on top of that. So when you look at nominal neutral, what do we use for inflation expectations? It's not 2%, or is it? And then on top of that, for the euro area, as you said, we've got so many disparate economies, adds another layer of complication. So I don't think the ECB is going to try and get too scientific about exactly where neutral is. But that guidance around what they're looking for as a terminal rate, I think, will be very important for the market reaction today.
What's more important to you with respect to your Euro call? The meeting today and the press conference of Christine Lagarde, or the meeting tomorrow of finance ministers in Europe to discuss the plan on energy and how to support some of the households dealing with incredibly high energy bills later this year?
I think both are key inputs into that outlook. If you think about the meeting tomorrow, there are so many different plans on the table. We've got the UK coming out today, something that's a lot more loaded on the taxpayers. In the euro area, it feels like we're going to have something in the form of a windfall tax. And so it certainly shapes the outlook for inflation and also for growth, for consumption, for disposable income. I do think the other key factor to take into account is just where positioning is at the moment. We've had a lot of questions in recent days from clients, particularly those not as actively involved in the FX market, as to why the euro isn't weaker. When you see the yen coming under so much pressure and we hear so many headlines around gas and Russia and so on, why the euro isn't doing worse. And the fact that we seem to be just grinding lower at the moment, I think, tells you a lot about how people are positioned right now.
Elsa, can we just finish on sterling? We're about to get the biggest fiscal package, one of, in the history of the country. What do you think this is going to do to that market?
It's a great question, John, because when you look at sterling, it's had a shocking time recently. But a lot of that has actually been down to a lack of monetary policy credibility, not fiscal policy. And underneath the surface, this fiscal package could actually be unbounded in size, depending on how they structure it. If prices continue to rise, the price tag could be enormous. The UK is probably the worst place in the G10 to stomach that bill.
114.91 on sterling right now. Elsa, thanks for being with us. Elsa Linhos there of RBC on the ECB, on the Fed and the BOE. What a moment for the United Kingdom. A little bit later this morning, we'll hear from the Prime Minister Liz Truss addressing Parliament and unveiling a plan to offset this energy pain. And as Elsa indicated, Tom, it could involve uncapped liability for the British government, the Treasury and for the gilt market. This is a big, big moment.
The answer is we talked about a couple days ago before my sabbatical. I mean, I'm sorry. All it is about issuing debt. I mean, that's all there is to it, right, John?
At what price? Yields higher, sterling weaker. The Chancellor, Lisa, I'm sure you noticed this, the new Chancellor was very keen to start the first day and point out that he backs the independence of the BOE, the central bank. And to Elsa's point, central bank credibility has been a big piece of the puzzle in the last month or so.
So how do they remain credible? Do they keep raising rates that much more, even into weakness, at a time when the government is trying to borrow money? Basically, do they move away from the fiscal plans in order to support inflation? And then what does this do if you get this sort of unfortunate spiral, I should say, of higher rates, higher borrowing? And then where is the pressure relief? In the currency? In the credit markets?
It just feeds on itself, doesn't it? And it's hard to break. It's hard to cut. It's not just the BOE, Lisa. It's the ECB hiking into recession potentially. We get the forecasts a little bit later this morning as well. I wonder if a recession is in those forecasts in the same way, Lisa, that it's in the Bank of England.
If it's not, I imagine there will be rather scathing criticism, considering the fact that even the CEOs of major banks are saying that it seems inevitable.
Luke Howard's got things to say. He joins us from UBS in about 50 minutes' time. Looking forward to that. Futures unchanged on the S&P. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The European Central Bank is on the brink of a jumbo 3/4 point increase in interest rates today as it tries to back control over record inflation. A majority of economists surveyed by Bloomberg predict that the ECB will take an unprecedented monetary tightening step. Well, Goldman Sachs has lifted its forecast for the pace of interest rate hikes by the Federal Reserve. Goldman now expects the Fed to hike by 75 basis points this month and 50 basis points in November. That's 25 basis points higher in each case. Goldman's economists write that Fed officials seem to imply that progress toward taming inflation has not been as rapid as they would like. Liz Truss will use her first significant act as the UK's Prime Minister to try to ease an historic cost of living crisis. Today, Truss will lay out her plan to tackle soaring energy bills. The government could end up spending as much as $230 billion over the next 18 months to contain energy prices. President Biden is holding back on a decision to scrap any Trump-era tariffs on China imports. Earlier this summer, the president had signed off on an exclusion process for exemptions from tariffs on manufacturing materials imported from China. Bloomberg's learned the administration is studying ways to help businesses seeking relief. And Tesla's operation in China are back in full swing after a factory upgrade and a lockdown slowed production. The electric car maker delivered a near 77,000 Chinese-made vehicles in August, and that's a sharp rebound from the 28,000 that were built in July. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I think it remains a distinct threat that there could be a military contingency around Taiwan, and the People's Republic of China has actually stated as official policy that it is not taking the invasion of Taiwan off the table.
That was David Rubenstein speaking with Jake Sullivan, the U.S. National Security Advisor. You can watch the full interview September 21 at 9 p.m. in New York on peer-to-peer conversations. Looking forward to that in a couple of weeks' time. This headline just dropping from Secretary Blinken, Tom, making an unannounced visit to Kyiv, Ukraine. So there you go, that headline dropping just moments ago, TK.
We see this, I'll say that former Prime Minister Johnson maybe is the one that started that trend, but it's becoming more and more. It was something, John, the other day to see Mr. Zelensky opening the bell of the New York Stock Exchange.
I'll get you a little bit more on that a little bit later. Futures right now unchanged on the S&P 500, on the Nasdaq 100 unchanged as well. The yields come in a couple of basis points, 324 on a US 10-year. Crude got hammered yesterday, 81.50 on WTI. And euro dollar just about at parity going into this one with the ECB. So it's 6:20 Eastern time now, 6:19. Right. 8:15 Eastern time is when we get that ECB decision.
Nice use of clock, John.
Thank you, Tom.
John, crude, West Texas Intermediate, American crude, under $80 a barrel. January 10th was the last time, way before the war in Ukraine.
Brent 87, Tom. Interesting stuff.
Let's have a moment of joy for Edward Morris at Citigroup, among others, nailing this demand destruction that we've seen. Let's digress to Jack Fitzpatrick, Bloomberg Government in Washington. And Jack, within the zeitgeist, and Bloomberg has it, Glenn Thrush, I think, writes it up at the New York Times nicely this morning. What does Garland, the Department of Justice, do about this special master question? I think the mystery of this is tangible. Make it clear for us. What's next?
It's tough to make it clear because the special master could slow things down. I think that's one key concern from the FBI and the Justice Department, is that it's not clear right now how long the process of reviewing all of this will go on. The next step is not imminent. We know that, or at least the very significant next step, because the Justice Department has its guidance that they're not supposed to take very, very significant legal actions, like if they were to charge former President Trump with any crimes within 60 days of an election. Yeah. So they're already in a bit of a holding cycle. Right. But one of the main questions they face now is what does the special master do to whatever timeline the Justice Department had in mind?
Jack, my knowledge of this is Perry Mason, that my mother used to watch. I was far too young to watch it, John and Lisa. But so I'm watching Perry Mason, and the problem gets solved by the end of the episode. If they appeal this, doesn't that happen somewhat rapidly, so that it obviously goes to the Supreme Court somewhat rapidly?
An appeal could happen more rapidly. Again, if that goes to the Supreme Court, that's not a speedy process. So that's one reason why the timeline on all of this is pretty hazy. But yes, an appeal from the Justice Department would happen more quickly than that would not be bound by, for example, their 60-day guideline on not taking those kinds of actions. That could happen a bit sooner.
That's the domestic intrigue, Jack. As we just got that headline, Tony Blinken making a surprise visit to Kyiv in Ukraine. And this comes as the international picture gets somewhat muddied by the domestic economies of the U.S., but also in Europe with respect to oil and gas prices and some of the changing favor for supporting Ukraine. We know that Biden did have a call with European allies to shore up support. How tough of a bill is that to really push at a time of such pain in the oil patch and the natural gas patch?
Well, from the U.S.'s perspective, the challenge primarily would be trying to keep European allies on board. Obviously, increasing energy prices is not politically convenient anywhere. But one, it seems that the White House's focus is trying to keep everybody circling the wagons. You see that with the video call coming up with some European leaders today. The willingness to provide support for Ukraine is not flagging in the U.S. There's talk about another batch of military aid that Congress would provide, in addition to the $2 billion news that just came out from the State Department. One, yes, energy prices make things challenging. The U.S. is not there's no reason to think that the U.S.'s stance has fundamentally been shaken. The challenge that you see them trying to address with the call upcoming today is, can there be further displays of unity before things potentially get worse this winter?
Jack, thank you. Jack Fitzpatrick there, down in D.C., and I think that's the right point to end it on, Bramo. It's whether things get worse this winter for the Europeans. Good news over the last couple of days, if you can find some. It's all relative, of course. Last couple of days, gas prices in Europe just coming off a bit, especially this morning, again, down by about 7.5%.
I saw that, and perhaps this is because of the anticipation of whatever plan comes out of tomorrow's meeting with energy finance ministers around Europe. Also, Liz Truss possibly giving some indication of how she plans to lower things in the United Kingdom. How much is this also on the report in the Financial Times that European leaders are saying they already are moving away from Russian dominance, that they already have a lot of pathways, that Russians' clutch over natural gas has already lessened dramatically? How much is that sort of giving people confidence?
At what price? Ed Morse of Citi, what did he say to us yesterday? Here's the quote. It'll be somewhere between 2025 and 2027 that we'll see the prices in Europe coming back to where they were at the beginning of 2021. Tom, that's how long Ed Morse over at Citi thinks it's going to take.
It's the heart of the matter, and this really goes to the press conference today. And let me say, John, for you and me, it's not a snooze fest, and the answer is the x-axis. Christine Lagarde's going to have to identify an x-axis that makes the Bundesbank and others who disagree on common ground. Good luck with that.
To the ECB, who once complained that you and I once called their news conference a snooze fest, I can tell the ECB they need to contact the Federal Reserve this morning, Lisa, because this won't be a snooze fest, and Chairman Powell is going to interrupt it halfway through it.
I love this. We're trying to basically create some sort of brawl here between the ECB and Fed Chair Jay Powell.
To get upset one day about us calling it a snooze fest.
You're basically saying if they're going to have anger, channel it the right people at misscheduling, because that's what's going on here. Okay, it's been stated.
Their news conference every single time. We do.
I know, and Jay Powell is just stomping all over it, making it difficult.
Have we ever seen anything like this at the same time?
No, I don't. I think it's a good question, John. I think the answer is no.
Kind of bizarre. Futures unchanged on the S&P. I promised I wouldn't bring it up again, and then I did 10 minutes later. So
you went down in
front. Oh, wait.
I won't promise twice.
What was that? Oh, Jay Powell's calling.
What did Jay say?
He said that it was completely coincidence.
I'm sure. Yields lower by a couple of basis points on a 10-year, 324. From New York, this is Bloomberg. Live from New York City this morning. Good morning. What a morning we've got coming up for you, with an ECB decision just around the corner, and you'll hear from Chairman Powell. At the same time, you'll hear from President Lagarde. No complaints here. Futures unchanged on the S&P, and the Nasdaq 100 unchanged as well.
None at all.
Off the back of the biggest one-day pop on the S&P going back to early August 10th, I believe. Yields look like this on 2s, 10s and 30s. Goldman Sachs changing their call. You've heard a lot about that this morning here on Bloomberg. They go to 75 for September from 50, and anticipate that maybe this Fed keeps hiking through 2023 as well. I think that's where the debate is at the moment. 343.53 on a 2-year. I think we can call a 2-year unchanged. One thing you cannot call unchanged over the last month has been the Japanese yen. Take a snapshot of foreign exchange going into this ECB call. Euro dollar slap bang on top of parity right now. Dollar yen 143.82, slightly weaker on the session. And Tom, this is happening. This is happening even with a bit of verbal intervention from Japanese authorities. Talking won't get it done right now. The issue at the moment, Tom, is action and policy. They're capping yields in the bond market. The upper band, I think, on the 10-year is about 25 basis points. They're keeping rates unchanged when everyone else is hiking, and that's why you're starting to see this yen weakness. Kit Jukes of SocGen this morning, I think, made a very, very interesting point about what comes next. He's saying this, Tom, for 2023, that what we're going to see is growth expectations elsewhere converge lower. And the Japanese economy starts to look a little bit more attractive, relatively speaking, as you look further out into 2023, Tom, as these central banks, including the ECB, tighten into economic weakness. The BOJ's not doing that. Kit's making the point that's when the yen starts to get a little bit more attractive. That's not where we are right now, but that story could just be around the corner.
Yeah, there's a lot of talk about that, John. You've had big figure moves in these currencies, and there's a point where you step in and go the other way. But there's so much, as Council on Foreign Relations says in their 100-year issue, there is just so much uncertainty out there. I don't know when the when is of the when or how I can analyze the when.
143.80 right now, Tom, on dollar yen.
And an ugly chart, and there's a few others out there to go with it as well. We're going to dive in here to the EU and UK economics and the choices to be made, including in America. Jennifer McCowan joins us, head of global economics at Capital Economics, formerly with the Bank of England as well. Jennifer, there's a wide understanding in America that the dynamic of West Texas Intermediate matters to Joe Biden, it matters to Jerome Powell. Brent crude is down 28% from the peak. Brent crude is back pre-Ukraine levels. Does that matter to Christine Lagarde and the governor of the Bank of England?
Well, it matters, but not as much as what's been happening to the gas price. And while that's come off, the wholesale gas price, while it's come off a bit lately, it's still, 10 times the pre-war levels. So that's a major issue in Europe at the moment, the one that they'll be focusing on. Yes, the decline in the oil price helps to take some of the heat out of energy inflation, but nowhere near enough.
Can you do real GDP analysis of Europe, or do you, with the huge inflation, are things so distorted that real GDP or nominal less inflation, the kind of traditional analysis, just doesn't work?
Yeah, it certainly makes things a lot more difficult. And I know some of the ECB's governing council members have said that at the moment it's as if they're in a dark room. So taking big steps in that situation is much more dangerous. And I think that's a really fair judgment of the situation. The high inflation level, the high inflation rates do make policy decisions difficult.
Can you give us a sense of just how challenging this moment really is right now for the Bank of England in the face of fiscal expansion, of expanding fiscal deficits, of Liz Truss about to explain how much she plans to spend, at least in the short term, to support households in the face of incredibly high natural gas prices? What would you be doing? Is the Bank of England just preparing to hike rates until the pain becomes too difficult for the economy to maintain any kind of momentum?
Yeah, well, the Bank of England's already said that there's going to be a recession. Unlike the ECB, it's been quite upfront about that and does intend to keep hiking anyway. I mean, the implications of this announcement from Truss today are a little bit mixed so far as the Bank of England's concerned, really. On the one hand, if she caps energy prices, then that helps to ease some inflationary pressure in the near term and maybe reduces the risk of sort of a wage price spiral in future, which is good from the Bank of England's perspective. But on the other hand, she's boosting demand and that raises medium-term inflation pressures. And what we've heard from MPC members so far is that they're more concerned about that. They're more concerned about the likely upward impact on inflation from higher aggregate demand. So I think it just adds to the case for the bank to continue hiking pretty aggressively for now.
Jennifer, when you were at the Bank of England, have you ever seen a fiscal package this large, this untargeted?
Oh, I can't remember, but it really is large. We're looking at about 6% of GDP, I think, if speculation is correct. And that's really big. It's big by international standards. It's big by past standards. What we've got to remember is that the UK's actually done relatively little so far compared to the likes of France and Greece, where we've seen bigger support, price level caps already. So we really were waiting for something to come through. And it's good news for the economy and for households. But the real worry is that it doesn't seem like it's going to be targeted in any way, and also it's funded by borrowing probably rather than by a windfall tax as other economies and other parties within the UK have proposed. So there are some concerns about what this does in future to the public finances and the prospect of needing to rein in the years to come.
So we could see one of two things happen, or maybe both. High yields, seen that over the last month, or a weaker currency. Yesterday, sterling broke down to levels we have not seen since the middle of the 1980s, 1985. We took out the low of the pandemic in March of 2020, 114.06. Jennifer, is there a moment when you look at sterling and you start to worry? And is that moment now?
I think that moment's not now. The UK is not like an emerging market. We don't have kind of large debts denominated in foreign currencies, so it doesn't feel like we're kind of heading into a crisis point. I think in terms of prospects for sterling, market expectations for interest rates might have gone a bit far in our view now. So it may be that ultimately it turns out that the bank doesn't need to go quite so far as markets are pricing in.
Jennifer, that was brilliant. Jennifer, help us here with what you just said so everyone calms down. You studied with Wendy Carlin at UCL, who I know knows the x-axis. And the answer is, if we assume a war that's been 6 months old, the United Kingdom has had wars that were a lot longer than 6 months. You issue debt and move on. I don't hear a panic in your voice about the issuance of new debt given a war. Am I right that everyone should calm down?
Yeah, I don't think it's time to panic at all. But I think what I'm more concerned about is what the issuance of this new debt means for the future. I think it would be more sensible to impose a windfall tax on energy companies, of which there are very large ones in the UK, to fund this. I don't fully understand why that hasn't happened. And I think the risk really is that there needs to be some consolidation of the public finances in a year or two to come.
What kind of inflation rate is the United Kingdom looking at a time when Citigroup put it somewhere in the range of potentially 22%?
Yeah, I think lower than that. It depends a lot on what Truss announces, really, but we're probably looking at a peak of perhaps more like 15%. But these rates clearly are astonishingly high. Inflation should come down pretty sharply next year, not least because of the very strong base effects that we have in energy prices at the moment, statistical effects. But still, there's little prospect of it coming back down to target within the Bank of England's normal framework of around 2 years.
Jennifer Micchione, we appreciate your time this morning. Really important morning for the UK. Jennifer Micchione there of Capital Economics. We're going to hear from Prime Minister Truss in any moment now, any minute now in Parliament, Lisa. And I don't think you do just move on, Tom. And this is the problem. You don't just move on. If you're going to take on uncapped liability, how can you move on when you don't know what's going to happen with gas prices? And I'd go a step further. What the Treasury's potentially putting themselves on a hook for right now is to pay the additional margin that the consumer would be paying, the additional profit margin to the energy company, and then not follow that up with a windfall tax.
Yeah,
now, Tom, what's that going to mean further down the road when we have some kind of fiscal consolidation in the UK to mop some of this mess up? Who's going to pay for that?
In your reading, who is holding back a windfall profit tax in the United Kingdom?
The Chancellor.
The Chancellor?
The Prime Minister.
The Prime Minister. Everyone seems to be on board with that. Their argument that they're making is the same argument the previous government, the previous leadership made. And Lisa, it's the worry that you don't get investment at a time when you need investment. I'd argue that things have changed a lot, and you can see how much they've changed in the last couple of days when we're facing down a plan from authorities that could amount to 6% of GDP. And Lisa, it's not like the furlough program. The furlough program in the pandemic was very targeted. That's not what we're going to hear.
So I think that it's fascinating to look at the transformation of the concept of conservative politicians, right? There is this idea of conservatism when it comes to business and profits and how you intervene on that side, but there's not the same conservatism with respect to borrowing, with respect to some of the support to households in a time of crisis. And this conflict is becoming more and more acute as you deal with a fiscal backdrop that looks really daunting at best.
Now, of course, we're basing our assessment on leaked reports of what we will hear in a couple of minutes' time. And Tom, it could well be different. Maybe the Prime Minister's had a change of mind in the last 24 hours and we'll hear something different. So all ears for what this plan actually is. But what we've been led to believe is the plan, Tom, is very, very big.
Yeah, absolutely. John, I'm watching the monitor here. The Prime Minister just stood up, but then she sat down because she was listening to you.
You think she's editing it, TK?
I think, no, she's getting up again. I love this, John. It's so different than America. I'm sorry.
She's going to speak at 9:08.
Well, the Prime Minister's starting right now.
She's going to speak when Powell and Lagarde speak. She's going to speak.
I think we can take a listen, Tom, if they've got the sound of this. No, they're going to the music for the break. We got the Prime Minister.
The new energy price guarantee that will give people certainty on energy bills. It will curb inflation and boost growth. This guarantee, which includes a temporary suspension of green levies, means that from the 1st of October, a typical household will pay no more than £2,500 per year for each of the next 2 years while we get the energy market back on track. This will save a typical household £1,000 a year. It comes in addition to the £400 energy bill support scheme. This guarantee supersedes the Ofgem price cap and has been agreed with energy retailers. We will deliver this, Mr. Speaker, but I will make way in a few minutes when I have made some progress. Mr. Speaker, we will deliver this by securing the wholesale price for energy while putting in place long-term measures to secure future supplies at more affordable rates. We are supporting this country through this winter and next, and tackling the root causes of high prices so we are never in the same position again. For those using heating oil, living in park homes, or those on heat networks, we will set up a fund so that all
Prime Minister, sorry about this. Can I just say, I don't want a running commentary from here and giving me the advice. I certainly don't need it. Prime Minister, I don't want to interrupt you. It's up to you to give way when you feel it's appropriate. But just to let you know that it is now being printed, the WMS, and I'm hoping they will bring it into the chamber for everybody to see. Prime Minister.
Well, thank you, Mr. Speaker. For those using heating oil, living in park homes, or those on heat networks, we will set up a fund so that all UK consumers can benefit from equivalent support. I'll give way to the honourable gentleman.
I thank you for giving me. National Energy Action estimate with the cap at the current level are 6.5 million households in fuel poverty. So raising the cap to £2,500, how many more millions of people will end up in fuel poverty, does she reckon?
Well, Mr. Speaker, we are taking action to help people on the lowest incomes through universal credit, and we are also supplying £400 through the energy bills.
The Prime Minister under pressure here in Parliament, unveiling her plan to offset some of the pain on energy in the United Kingdom. I'm very pleased to say that standing close by is Lizzie Burden. Lizzie, you've been listening to some of this. You've read the reports over the last couple of days. What have we heard?
Well, Liz Truss is saying that the plan is to limit the typical price of energy for a household to £2,500 a year. Remember, bills were meant to go up 80% next month, so this is going to be a huge relief to households. It's convenient, isn't it, that it's going to last for 2 years from October when there's a general election due in 2024. But it is going to be a big relief. The question is, how sustainable is this? If this is the new normal, we had Philip Hammond, the former Chancellor, on the programme, and he was saying, you know, people need to change their behaviour, right? The market needs to adapt, but the government's going in and subsidising the wholesale cost. So it's yeah.
Lizzie, is this bipartisan or is this the Conservatives alone?
I think I was having a discussion with an economist this morning about this. Whoever was going to be Prime Minister, regardless of whether it was Rishi Sunak or Liz Truss, whichever party they are, the parameters of this situation mean that this was probably the only likely outcome. You know, we've got the energy crisis is at the heart of the cost of living crisis. They had to stop inflation going above 20%, as Goldman Sachs had predicted. You know, the analysis from Bloomberg Economics is that this is going to mean inflation has peaked.
So, Lizzie, there is a lot of agreement that there needs to be some fiscal support for households. There is not necessarily agreement on simply abandoning the idea of a windfall tax. Why is that not on the table at all, even though a lot of people are concerned about capital flight, about foreign investors not financing this growing fiscal deficit?
I mean, Liz Truss was very clear in the Prime Minister's questions yesterday, her first standoff against Keir Starmer, that she was not going to use the windfall tax on energy companies. But then later in the day, it seemed that she would continue Rishi Sunak's level of 25%. And perhaps what she meant by that was that she wouldn't increase the rate beyond 25 or extend it to include power generators. So, you know, we've talked a lot about the difference between campaign economics and government economics. It's happening across a range of other areas, not to mention how they're treating the Bank of England, but this might be another one. You know, the position on the windfall tax isn't as clear as you might think.
Well, the Prime Minister said just this: no windfall tax to fund the energy support package. She said the Chancellor will set out the cost in a fiscal statement this month. Later this month, Lizzie, when we hear from the Chancellor, how big is this? I mean, I imagine they can't even give us a number, because surely this is dependent on what happens with gas prices.
Indeed, and that's what's going to be so scary with the charts that are probably projected on the walls at the Treasury. So much of the tab that they're picking up is unknown. You know, we had Hugh Pill, Chief Economist of the Bank of England, before lawmakers yesterday, saying that Goldman forecast of 22% was plausible, given what could have happened in wholesale gas markets. So, yeah, the Treasury is taking up a ginormous, unknowable tab here.
And doing it over 2 years as well. Lizzie, thank you. Lizzie Burden on the latest in London. 2 years, Tom. An uncapped liability potentially for 2 years. And the hope is, I imagine, that gas prices come down and that liability falls. But this is going to be very interesting to see what the Chancellor says later this month when the Office of Budget Responsibility comes out, Tom, with some estimates on what this all means.
And also what the Bank of England will do and how they will respond, how they will adjust to this. And John, I just have to say, there's just so many variables of uncertainty. I think the punditry and the gaming of it is, frankly, pretty useless. A lot of it depends on the economist Putin in Moscow.
Well, that's something that we can all agree on. It comes down to gas prices. And Lisa, that's going to dictate the cost of all of this as well. And whether this is eventually complemented with some kind of demand destruction, something to curtail demand in the UK, as the Europeans are planning to do so.
It's an important point, especially because Ed Morris, the person we've been talking about all morning of Citigroup, who got the call right with respect to oil prices and gas prices, is looking at the demand destruction in the United States as markets working. What happens when you interfere with markets? Because you have to. But where then do you add the extra consequence of demand destruction that's required to get back to some sort of normalcy?
Joining us now is Katrina Dudley, Portfolio Manager and Research Analyst at Franklin Mutual Series. Katrina, fantastic to get you with us on the programme. Dario Perkins this morning out on Twitter of TS Lombard said this: the 2010s, tight fiscal, easy monetary, yields at 800-year lows. 2020s, easy fiscal, tight monetary, yields at ... question mark. Katrina, what does all this mean for the bond market?
For the bond market perspective, we're looking at rate hikes that are unprecedented in terms of what we're coming from. We're in a situation where we're talking about inflation. 2 years ago, me talking about inflation rates of 20%, which we were just talking about in terms of the UK, we wouldn't even think that that was on the horizon. So from our perspective, it's a new economy, it's a new normal, and it needs a different type of analysis in order to adjust.
Can they issue the bonds with impunity? I mean, what's the so what of the amount of gilt bonds they will issue?
There's common sense. There's the need to ensure that there's a confidence in the payback. Look, obviously, I think that you've obviously seen people around for so long, the UK, that isn't going to be an issue. But the fact is it's not quite the wartime economics that people are thinking of, where you've had past bond issuances done in response to wartime efforts. This is really done in response to this energy crisis and the inflation it's creating.
So you're not linking what's going on in the United Kingdom to the war in Ukraine?
I think that you are seeing the fact that people are realizing that this dependence on gas, the dependence on Russia, is really hurting the economy. I think there are two things that need to happen. First of all, you need to get people being responsible for their own energy usage and realizing that energy has a cost, and you need to make sure that there is some level of demand curtailment that comes from having high energy prices. So that's the number one. Number two, we really do need to make sure our energy companies are helping us transition away from this dependency. And that means you can't have those windfall profit taxes that a lot of people are talking about, because we need these companies to invest. They need to be the partners alongside us in enabling this energy transition that has come to a head as a result of the war.
Which really raises a question about fiscal policy and just domestic policy in general with respect to the strength of an economy and the strength of a nation as an investment thesis. How long can the U.S. remain the one shining beacon amid a lot of pain that it has been over the past couple of months?
let's just take a look at the US market. You have energy security, you have defense security, and you have markets that are operating as they should. If we switch that conversation over to Europe, what we're starting to see, as we've talked about repeatedly, is there's the defense security. That spending needs to happen. That has obviously got implications from a fiscal point of view. We have energy security, and I think that we need to be considering that needs to happen. That needs to happen in partnership with commerce. Finally, we need to have responsibility. We also need to make sure, because in Europe, we're coming from a time where we've just had such divides and we've just had so many of these political parties arise. And I think that this high inflation, the haves and the have-nots, is really going to come into play and really change the political landscape further over the next 5 to probably 10 years. I would finish off with the one good thing about this policy I do like is Liz Truss is only doing this for 2 years. And while people are commentating that happens to align with the next general election, she also is not putting a hamstrung and basically boxing in her predecessor, or it could be her as well, into continuing these policies. And I think that that's really important, because we want to roll these things back if the market starts working the way we think it should.
Okay, so Katrina, what's the level where you would feel comfortable investing in sterling, investing in 10-year UK gilts?
In terms of the currency, I think that, the euro's at parity, for example. You look at where the British pound is. I think that there are always opportunities. I tend to bring things down to the stock level, and so we're looking for opportunities in UK stocks where we think the market has really over-penalized them against this kind of negative backdrop.
Katrina Dudley, thank you for responding to all of this. The Franklin Mutual series, the Prime Minister of the UK, Liz Truss, just moments ago. No cost-free options in the global energy crisis. If we were to define this morning, and the decisions that need to be made, they're not the optimal, the best decisions, Lisa, they are the least worst decisions they can make. And that's the opportunity set, the decisions in front of them. What's the least worst? That's a tricky position for anyone to be in, and that's what we talked about all yesterday.
Has there ever been a prime minister who came into a worse economic backdrop than Liz Truss is right now?
I thought Theresa May had a difficult hand. Said that yesterday, didn't I?
Yeah, I mean, this is to me a real question.
Liz Truss, this hand is really, really tough. What other choice did they have but to come out with something like this?
John, I've been thunderstruck by the last 48 hours. I feel like a complete amateur. You've lived this. I was absolutely stunned at the diversity and the age of this cabinet and this prime minister. It is so radically different than America.
Conservatives have a history of that, Tom.
Stunning.
Yeah, I think anyone who's been following the Conservative Party for a while, they have a history of that, Tom.
I think the youngest person, John, we have in Washington is 75. I'm kidding, but, it's been a change, John. And, she's stepping forward here. What's the next step for her, though, John? I mean, what's after this energy announcement? Then what?
I think it all depends on what actually happens with gas prices, because although they've capped things for the British consumer and they're trying to help British business, Lisa, the problem is if gas prices keep climbing, and I have no idea if they do or not, that's going to dictate how much they have to cover to the energy companies. The more money the energy companies make, the more pressure there will be to revisit that idea of a windfall tax, which is something currently, which they've explained again this morning, that they're against.
And there is this idea, and we were just talking about that these energy companies need to be part of the transition away from energy dependence to a greener reality. They need to invest, but what's the incentive going to be, right? I mean, if you're plugging that gap, if you're giving that money to them, how aggressively can they hire in a deteriorating economy? How much can they put that capital to work to really get a different kind of energy system? I mean, it just creates a whole host of very complicated issues.
Do you think that the next Bank of England rate decision might be a little bit complicated, with the UK expecting the plan to curb inflation by up to 5 percentage points?
Yeah, I don't really.
September 15th, put that in the diary for the Bank of England's next big call. The ECB is just around the corner. We'll catch up with Luke Cower of UBS. Looking forward to doing that in just a moment. Futures positive, about 1/10% on the S&P. On the Nasdaq, we're up about 1/10%. Also, with Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. For our audience worldwide on TV and radio, this is Bloomberg.
The Fed have laid out their course. They're going to be hawkish. They're going to continue doing what they're doing.
Dollar strength at the moment is helping the U.S. inflation story.
You're seeing inflation in the United States still increasing. It's going to be a real problem until the Fed gets their arms around the demand side.
The Fed is very much committed to raising rates.
Eventually, the Fed usually does win out in the form of slower growth and eventually a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Stay tuned for a gripping couple of hours for global central banks. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures up about 0.1% on the S&P. In the next few hours, you'll hear from President Lagarde and Chairman Powell, Tom. That's just around the corner.
Well, Liz Truss just moved the pound. We've had a nice rally in pound sterling off of the energy announcement by the new Prime Minister of the United Kingdom. You wonder what Lagarde will do in moving a euro at parity.
Well, Tom, Lagarde has got a lot of work to do herself. Can she move the euro with higher interest rates? Is it even about higher interest rates, Tom? Does that make a difference to this euro that's gripped by gas prices across the continent, and what's going to happen with that economy into the winter?
Yeah, and within a war economy, and certainly the updates of Ukraine taking some square footage in Ukraine this morning shows the back and forth here of the war, John. I mean, she's got to address the war and the uncertainty forward, which is going to be number one.
What do they say in markets, Lisa? You buy the rumor, you sell the news?
Yeah.
When it comes to sterling, you sell the rumor, you buy the news?
I don't know.
Story?
You know, right now I'm looking at the pound and it's up 0.1%, and I could just wonder how staying this is going to be and what people are trading on, how liquid this market is at a time when you've called it, or other people have called it, I don't want to throw you under the bus, an emerging markets currency, or trading like one, given all of the volatility behind the scenes. Right now, what we're looking at is a market being dictated by something other than central banks, and central banks are bankers scrambling to try to give some sort of sufficient response.
Are they going to keep on hiking, potentially into recession in places like the UK and particularly in Europe as well? Can they keep on doing that, Lisa? I think we've all been surprised by the scale, the magnitude, not just of the fiscal intervention from the UK this morning, which is humongous, but also by the ECB. The fact we're talking about 75 basis points from the ECB is something we were not discussing at all even a month ago.
This can't be overstated. We were talking not so long ago about $17.7 trillion worth of negative yielding bonds, of bonds that yielded less than zero. Now that number has dropped to about $2 trillion. That is in Japan. In Europe, you are looking at the possibility of a 0.75% interest rate after today's meeting. How much does that change the absolute scale of what we're talking about with borrowing, with economic volumes, at a time when you're also facing a lot of constraints with respect to energy prices?
You mentioned Japan. The headline from Japanese authorities this morning, Tom, these FX moves are clearly excessive. That's their take. Bit of verbal intervention early this morning.
I've seen it before, and as I mentioned earlier, John, to me it's just a question of this experiment they have, which devolves down to who owns the bonds. And the answer is they're co-opting the bond ownership in Japan. John, help us here with the translation. In the United Kingdom, the Prime Minister ending moratorium on shale gas extraction. As you know, John, the Chancellor of the Exchequer has been really overt about North Sea oil. John, what does it say? And it folds into Lagarde today about shale, about coal, about uranium, about a new ESGE given the cards dealt.
Well, it plays into a question you've asked, Tom, a million times. Is ESG dead? Is this the new reality of the energy story in Europe and beyond?
I mean, how does Labour respond to this? And how does Labour across Europe respond? How do they respond to what Lagarde says here in 2 hours?
Liz Truss saying this: we want to make the UK a net energy exporter by 2040. Lisa, that's going to take a lot of investment, and for that reason, that's why they say they're against, at the moment, a so-called windfall tax.
Right, but how do they guard this investment? How do they push it in certain directions that they want to see? And there are a lot of questions here that remain to be seen, and how this sort of justifies a fiscal backdrop that counts on some sort of energy independence by 2040. I don't know. It's a really tricky one to sell.
It's a tough spot for any policymaker right now. Live from New York this morning. Good morning. If you're just tuning in, we'll hear from Chairman Powell and President Lagarde a little bit later. Lisa's going to give you the times in just a moment. Separately, Tom, and we're going to have to work out on Bloomberg TV and Radio which one we bring to you at what time. Futures on the S&P up 0.2%. On the Nasdaq 100 up 0.2%. Also, yields coming in a couple of basis points, 324.65. Gas is down in Europe. That's some good news for you. Crude has been lower in the last 24 hours as well, though it bounces back just a little bit right now, Lisa. 82.50 on WTI, up 6 or 7 tenths of 1%.
I would argue that if we wanted to take one of them, we should take Christine Lagarde, because I argue that this is actually the more important news conference, the more important statement at a time when the Eurozone is facing a much more severe crisis in many ways than the United States. Today, we do get the ECB rate decision at 8:15 a.m. and Christine Lagarde, the head of the ECB, speaking at 8:45 a.m., which does conflict, as we're about to talk about, with Fed Chair Jay Powell, who's going to be commenting. The euro has been deteriorating. What kind of rate hike will actually support the currency? And that is something that we've been asking for months, and we might get some sense of that today. 9:10 a.m., Fed Chair Jay Powell participating in a moderated discussion at the Cato Institute. Yes, it is awkward timing, especially because there is a question about how much the Federal Reserve sees itself as central banker to the world. There actually are a pair of papers being released at the same time from Brookings, from different independent academics, saying that the Federal Reserve is not adequately accounting for how much pain needs to be suffered around the world in order to get inflation lower, given the dominance of the dollar, given how high rates are expected to go and possibly may have to go even further. Other Fed speakers today include Chicago Fed President Charlie Evans and Minneapolis Fed President Neil Kashkari. And at 2 p.m., we hear from someone who we have not heard from for quite a while. U.S. Treasury Secretary Janet Yellen, she's giving a speech on some of the green policies of President Biden, the latest fiscal spending package. She's going to be in Detroit. But this goes to this question, John. Is ESG dead? If we have Treasury Secretary Janet Yellen trying to push this, and we do have some financing for it in the United States, how does that conflict with the reality on the ground that's very much prioritizing some of the older, unclean energy sources like coal and like a lot of the fossil fuels?
Looking forward to it. We need to hear from the Treasury Secretary coming up a little bit later. Joining us now is Luke Cower, Director of Investment Solutions at UBS Asset Management. Luke, I'll ask the question a lot of people asking. Good to see you, mate, as always. When did the rate cuts start?
Well, in our view, that's still the kind of the trade to be fading. And I mean, there's still going to be a degree of stickiness in all of the cut odds at some point, just because if you run any back tests, it's going to tell you after the, Fed hikes this much, this fast, then, we're returning to cuts next year. I think in all of the rate volatility we've had this year, one thing that's been consistently underestimated is the sturdiness of the U.S. consumer, the sturdiness of the U.S. labor market. So that combined with a Fed that's not going to be too quick to kind of throw in the towel on declaring victory on inflation, I think that's a recipe for trying to think of a tactical investment environment without needing rate cuts to support the case of any of your positions. That's, one of a higher conviction call of ours right now is that, that's something that you shouldn't see more and more priced in. We've priced them out a lot. Is there kind of room to go? Maybe, but that's going to be more of a kind of decay in pricing, getting rid of the rest of the cut odds. And that's going to be, every month, the U.S. labor market showing you that, hey, it's taken a bit of a licking, still kicking.
So it's a potato, not a lobster. Is that your take, Luke?
Yes. No, I just, kind of a joke here, just looking at, something someone told me about the lobster's thrown in a pot of boiling water, it dies. The potato, it's softened, and the Fed thinks by putting the U.S. economy into this boiling water of rate hikes, it's killing it, but really it's just preparing it, making it very nice for us to eat like a good mashed potato. The ramifications for the rest of the world in terms of dollar strength and what Lisa was kind of alluding to in papers that are going to be released. Yes, this is a tightening of financial conditions for the world over, more so than is being delivered to the U.S. economy. And one thing I think we've learned this cycle that's different from 2019 is that once you start caring about inflation expectations, then the luxury of being central banker to the world, it disappears.
Luke, I miss you. Your food shots on Twitter and some of your culinary-minded analogies are fabulous. I am wondering what this means for allocations. I know you are neutral on equities in the U.S. What does that mean? And is the rest of the world, for the most part, uninvestable?
Certainly not, but I would say that kind of as you look across the spectrum and kind of staying neutral at the asset class level for us, that's the duck floating on water under the surface. Our legs are kicking a lot to try and find some trades with convex profiles at the kind of at the relative value level within asset classes. Kind of one thing we still do think is that from the perspective of relative equities, there's a lot of defensive trades out there that still make sense. So, even as you might be thinking, well, rate vol has peaked, that's traditionally going to be a good thing for financial assets. Well, it's tough to get too optimistic about earnings power in an environment where you're still expecting economic activity to slow. Is the rest of the world uninvestable? Certainly not. But if you look at a lot of the things that could, quote unquote, wreck risk assets, a lot of the different scenarios from a macro perspective, you'd be looking at a stronger dollar is something that upsets the apple cart in a lot of cases, whether that's just a good news is bad news type dynamic, whether that's an energy price shock, which is going to be more FX in terms of trade negative for countries ex-US, or whether it's a kind of swift descent into recession. So that's still something from a portfolio context that makes a lot of sense. And there's short USD exposures out there that are better expressed outside currency, we believe.
Luke Cower, the author of Cowernomics. Great to catch up, as always. UBS Asset Management's Luke Cower. Lisa, that's what I'm calling it, Cowernomics.
I'm going to call it Cower Cooking.
I think it's great. It's a great analogy. And every time we get a decent jobs report, that's what I'm kind of looking at, this idea that maybe Luke's right, that this labour market is more resilient than people thought it would be.
Well, and how much does this hinge on the fact that gasoline prices have gone down so dramatically in the United States by about a quarter from their peak? Right. How much are you looking at that supporting spending, and how much can that continue given what you are seeing with the Strategic Petroleum Reserve and what you're seeing overseas?
John, I think what's important with Luke Cower, and this goes to all of his analysis, he takes every single analysis at UBS back to when the Toronto Maple Leafs last won, which was 1967. The Dow is up 10.2% per year since 1967.
Is that what you were busy doing in the last 5 minutes?
Yeah, but I mean, I think it's a lot Luke Cower analysis back to when the Leafs last won 52 years ago.
You could be his intern, Tom.
52 years
That would work out well.
Yeah, it would work out well.
Tom Keene, Lisa Abramowicz and Jonathan Ferro. Futures up by 0.2%.
It's not a snooze fest.
The ECB, about an hour away, live from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In the UK, Liz Truss's government has announced a sweeping package of measures to contain spiraling energy bills. The goal is to ease an historic squeeze on the cost of living that's likely to define her premiership. Now, the program will cap the amount consumers pay for natural gas and electricity. It will cost the government billions of dollars. The European Central Bank is on the brink of a jumbo 3/4-point increase in interest rates today as it tries to take back control over record inflation. A majority of economists surveyed by Bloomberg predict that the ECB will take an unprecedented monetary tightening step. President Biden will host a video call today with allies on support for Ukraine. Now, among those taking part, the group of 7 leaders, along with leaders from the European Union and NATO. The call is taking place at a key moment in the war. Ukrainian forces have launched a counteroffensive against Russian troops. Meanwhile, Vladimir Putin meets with China's Xi Jinping next week. President Biden is holding back on a decision to scrap any Trump-era tariffs on China imports. Earlier this summer, the president had signed off on a new exclusion process for exemptions from tariffs on manufacturing materials imported from China. Bloomberg's learned the administration is studying ways to help businesses seeking relief. And Tesla's operations in China are back in full swing after a factory upgrade and lockdown slowed down production. The electric car maker delivered a near-record 77,000 Chinese-made vehicles in August. That's a sharp rebound from the 28,000 that were built in July. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
This guarantee, which includes a temporary suspension of green levies, means that from the 1st of October, a typical household will pay no more than £2,500 per year for each of the next 2 years while we get the energy market back on track.
Fiscal intervention from the British Prime Minister Liz Truss just moments ago, live from New York City this morning. Good morning with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures up by 0.1% on the S&P, on the Nasdaq up by just 0.05%. In just under a little less than an hour from now, we'll hear from the ECB, a rate decision. Then 30 minutes after that, we'll have a news conference with President Lagarde for you. Going into it, parity for euro dollar, almost totally unchanged, positive almost 0.1%. Luke Howard of UBS on moments ago, referring to the labour market as a potato, not a lobster, something that does not die in the face of hot water and rate hikes, something that softens a little bit. Steve Englander of Standard Chartered, weighing in. It's a noodle, cooked carefully, and it's nice and tasty. Cooked too much and it falls apart.
Now look what you have started.
Look at the contribution from the South Side in America, Tom.
Fresh pasta or dry pasta?
We'll find out. Maybe Steve will follow up. There you go.
The way I cook, it's a Swanson TV dinner, hopefully defrosted before you. John, do they have TV dinners in the United Kingdom?
No, not the ones you've described to me. Do they have microwave meals? Of course they do, Tom.
But
not. I've not heard of your TV dinner before.
Panache.
Sounds like the 70s, Tom.
Exactly, or even the 60s.
Wrong decade.
As well. We'll do a sterling analysis here in a bit, but right now, time's a-wasting. Will Kennedy joins us at Queen Victoria Street, of course, running all of our energy efforts as well. Will, in the zeitgeist in America, is it somehow this is going to get fixed? And one of the ideas is Norway to the rescue. And there's other Norways as well. Do you and our team have an optimism that Europe can cobble together an energy solution?
I think there's a real determination in Europe and the UK right now to put together a package of measures that just get us to April, get through this winter. This winter is going to be the really difficult time without Russian gas. Hopefully next winter there'll be more supplies. What does that look like? It looks like every drop of gas we can get across the Atlantic from the US. It looks like every drop of gas we can get out of Europe. And it looks like cushioning the blows, as we've been talking about in the UK, for consumers. And it looks like making sure that the energy market has the liquidity it needs.
What's interesting here, Will, politically, is the Prime Minister mentioned shale. The Chancellor of the Exchequer, newly minted, loves to dash up to Aberdeen and look out across the North Sea. Can the United Kingdom actually come to its own rescue by development of the North Sea further?
I think that most people in the industry think that that impact will be marginal. Now, of course, there's been a lot of political cross currents here. I mean, a year ago we were in Glasgow and we were talking about the energy transition, and there's a lot of pressure on British politicians to stop development of our very mature oil and gas industry. Now that has changed, and I think there's a real will to get people drilling again. Will that drilling produce much more gas? That's doubtful, and it certainly won't in the short term. And then when we look at fracking, there's always been lots of excitement about fracking. There is gas in the northwest of England in particular, but it doesn't look like Texas. It's crowded. People live close together, and they don't want huge trucks full of sand and huge drill rigs in their back gardens. And the other thing is, they don't own the royalty under the land. The Queen owns that. In the US, if someone finds gas where you live, you get some money. That's not true in the UK, and it makes the politics very, very different. So I think fracking will struggle to get off the ground.
Wait, John, does the Queen own the land under Shea Farrow in the Midlands?
No, that's ours, Tom.
Okay.
That's mine.
I just was lost there for a minute.
That's mine. She's not having that. Will Kennedy, the leader of the opposition, Sir Keir Starmer, saying this: the windfall tax is now the basic political divide. The Prime Minister this morning has unveiled a plan to cap prices. They'll cover the difference with the energy supplier. So this is uncapped liability, as you and the team have reported all week. Can you run me through what we heard this morning and why they are not keen on a so-called windfall tax?
I think it's a political, almost ideological thing, John. Clearly, Truss has come into office on a very a platform of very pro-business platform, a tax-cutting platform, and I think that the last thing she wants is to make her first policy a new tax. I think she's very opposed to it. So, you know, the argument is that they want the industry to have the capital to invest in renewables, to invest in fracking, to invest in the North Sea. But clearly, it does open a dividing line about who's going to pay here, because at the moment, it's the taxpayer who's going to pay for all of this, as you say.
Which raises the question of whether this headline on the Bloomberg terminal makes any sense on any kind of logical way. Not the headline, but the conclusion of it. UK says energy aid will cost Treasury billions and cut inflation. Is that a plausible outcome?
It probably is in the short term, because when people made their very apocalyptic forecasts, I think Citibank said 18%, maybe Goldman said 22% about how high inflation could get in the UK over this winter. That was largely based on the idea that the energy price cap for households would be allowed to rise and rise and rise, and you might get households paying £5,000, even £6,000 a year. Now, by capping it at £2,500 for 2 years, that element of inflation is taken out of the equation. So there is a sense in which it will put a cap on inflation. Now, obviously, as you say, Lisa, there are longer-term dangers about what happens to the state of the British finance, what that means, British balance sheet, what that means for the pound. But I think in the short term, yes, one of the attractions of this policy is that it will have a positive impact on the inflation numbers.
Well, you framed that perfectly. Thank you, sir. Will Kennedy, out of London. Just perfect. Talking about how, on the one hand, it will reduce inflation because you're capping energy prices, reduce it relative to what we would have expected through much of next year, but also at the same time, it introduces a bit of risk, Tom, into the gilt market and to sterling as well.
Absolutely.
And sterling's been a channel through which we've imported inflation into the UK with a much weaker pound.
The deterioration in sterling is stunning. Folks, very quickly here, I don't want to get too mathy, John. The midpoint of the volatility study of sterling is a stunning 117.66-ish. That is miles away. Trust moved sterling this morning, John, but it's a blip compared to the deterioration we've seen.
Oh, the low yesterday, Tom, towards 114. Brutal. 114.06.
Yeah.
TK, I was joking yesterday that you were in the line for the new iPhone. Were you in the line for the new iPhone?
No, I didn't get the
when
old one.
When does the line for the new iPhone start? Does that even happen anymore?
This is old. I didn't get the 13.
You didn't get the 13?
But, John, they've made a watch for you finally. I mean, folks, you don't know this. I mean, Abramowicz is running 20 miles a day. John swims the Hudson River, and there's the new Ultra watch, finally, and I think Tim Colpin writes this up for Bloomberg brilliantly. John, a watch for you. It's priced like a Patek, but
how much
John,
is it?
It's like a Patek. I don't know, 15 grand, whatever.
A Patek's more like 40, isn't it, Tom?
I don't know. You can get an Hermes watch band with it, John. It just says you. I mean, I thought of you when I saw this.
I'm just not into those kind of watches, TK. They just don't do it for me.
But you could check
if anyone
what
wants
time
to send
it
me a
is
Patek,
when
I'll
you're
take a
swimming the
Patek.
Hudson.
From New York, this is Bloomberg. Binky Charter of Deutsche Bank came out yesterday and said this: if you get a recession on the S&P, we'll see 3,000. If you don't get a recession, we might rally back to 47.50. Helpful, Binky.
That's
Need a chat.
Yeah,
Can we have a conversation, please? The difference between a recession and not a recession is 3K or 47.50.
Oh,
Looking forward to catching up with Binky Chadha in the next couple of weeks. Futures unchanged on the S&P 500. On the Nasdaq right now, basically unchanged as well. Into the bond market, you've heard the news from Goldman. They're on board with 75 for a decision from the Federal Reserve later this month. Your two-year right now, 342.49. Basically unchanged there. Going into the ECB, the euro basically unchanged as well. Even with some verbal intervention from the Japanese authorities, dollar yen not doing a whole lot in their favour. Dollar yen right now, 143.54. Just the tiniest bit of Japanese yen strength. And we're all looking at sterling at 115.35. Yesterday, the low of the session, 114.06. That took out the pandemic lows for cable. The weakest currency, the weakest sterling we've seen against the US dollar, Tom, going all the way back to the mid-80s.
Right.
And what we heard from the Prime Minister, Liz Truss, in the last hour, Tom, to cap energy bills, the exact price of this plan is hard to say, because it all depends on where gas prices will be. But it could be, Tom, 200 billion plus over the next 2 years. We'll see.
John, I think this is so great. I'm so glad we have this moment with you. A former prime minister speaking from behind the bench to the new prime minister. John, I believe I have to go back to John Quincy Adams for an American equivalent. John, explain this. This is, to Americans, this is as foreign as it gets.
Well, Tom, you're an MP first. And if your party has a majority in Parliament and you're the leader of that party, you're the Prime Minister. She was the leader of the party with a majority, but she's still an MP.
Right.
And that's the story. So she's a member of Parliament. She's still in there. She's asking questions, interventions, asking questions of this Prime Minister. That's just the system, Tom. It's how it works.
And they're not building a Prime Minister's library for Theresa May, are they?
No, Tom. No,
It's
she's
just
not got
so-
a big
I'm
foundation
sorry.
with
I had
tons
a-
and tons of money pouring in and doing great stuff.
I editorialized. Continue, John. I didn't mean to interrupt, but I just thought that was a great
I'm sure
moment.
you did not mean to interrupt.
Yeah, I never did.
What's
Never,
going on today,
ever.
guys?
That's the cross-asset price action. Let's get you some single names. We can do that with Lisa this morning. Hey, Lisa.
Hey, how's it going? I'm keeping my eye on retailers today because we are getting the last drips and drabs of this earnings season. Yesterday, we got American Eagle coming out with disappointing second quarter earnings, actually pausing their cash quarterly dividend. Those shares down almost 15% ahead of the open. And Wayfair, also a retailer, seeing its shares decline nearly 10% in pre-market trading after selling a $600 million of convertible debt. So some concerns about dilution. One stalwart is GameStop. This story is never ceaselessly fascinating. 7.5% gain ahead of the market open, not because the earnings were so great. They weren't. They were actually particularly soggy. But it was a partnership with FTX that really got a lot of people's attention, and because of the passionate stockholder base or something like that, which was what some of the executives of GameStop called it. Elsewhere, we're looking at some of the pandemic darlings that have seen rather soggy post-pandemic fortunes. DocuSign among them. Those shares did lower by about 0.25%. They report earnings after the bell today. Question that a lot of people have is how low can they possibly go, considering the fact that they've already declined about 60% so far this year, 80% over the past 12 months. So have we already priced in everything possibly that could get thrown at them? And I think that the bar has been set at so low that perhaps some people are getting a little optimistic, maybe. Roku shares popping just a touch up 0.9% as they are upgraded by Pivotal Research on the potential for a more robust outlook. And Apple shares are lower by 0.2%. Hard to call this a mover, but interesting to see that the shares popped yesterday after the release of the new iPhone, especially because they paused price hikes. They actually are offering it at the same price despite some of the inflation going forward. This is a really interesting nod, Tom, to the competitive landscape as well as the deteriorating willingness of consumers to just absorb everything.
Just getting some headlines, Lisa, on the Queen. The UK's Queen Elizabeth to remain under medical supervision. According to these headlines, doctors are concerned for her health. Tom, those headlines just dropping moments ago. That's all we have so far, that the Queen is to remain under medical supervision and that doctors are concerned for her health. Any updates? And I'll bring them to you.
And a photo of a fragile Queen with the new Prime Minister here in the last 48 hours as well. Right now, we move forward to the call of the summer, which was out of TD Securities, and that would be Priya Misra. The dovetail of that is maybe the call of the last 12 months, indeed 24 months, which is her colleague Mark McCormick. His resilient dollar call was absolutely brilliant in hindsight. He joins us this morning. Mark, are you still resilient dollar?
Yeah, we still like the dollar short term. We upgraded our forecast. We're looking at DXY probably test about 112, so it's about 3% from here. I think there's going to be some split, whether it's we look at the Japanese yen relative to European currencies, but right now, most of the shock is going to come through euro and sterling.
I love your cross-rate analysis. You've got some odd ideas, which are great. Taiwan against Korea. You've got Swiss franc against Japan. And that, is it a point where we can't look at the more comfortable pairs we look at normally, and we have to go to other currency pairs?
Yeah, it's a great question, because what's interesting is that all the things that are happening around the world are kind of driving different factors to make different countries more valuable than others. So in that context, the number one thing that's still driving everything is terms of trade, so the energy shock. So it's more important that we look at oil prices for Japan, and it's more important that we look at the electricity and the energy and the natural gas markets in Europe. And so the terms of trades are diverging, which should be beneficial for the yen over time, but it's still kind of a drag for the European currencies. When we look at Asia, what we're seeing is financial conditions are easing through China, but they're tightening in Europe, and they're slightly tightening in the U.S. So there's a massive gap between Asia, the Americas, and Europe. So what we're seeing is there could be scope here for Asian currencies to start to recover in the months ahead, even though we think dollar China should touch 710, because we're starting to see equity flows come back. So there's a really complicated mix of valuations, relative equity divergence, terms of trade shock, and all these things are creating gyrations across all different currencies.
I want to sit on a point that I think you're making just a little bit longer, that perhaps the energy prices are more important to the outlook for currencies than rate calls by central banks around the world. And this is something that we've been talking about quite steadily. So what are you looking for tomorrow from the energy finance ministers in Europe who are going to be meeting? What kind of plan could give you some confidence that we've seen the bottoms for the euro?
So I don't think there's a lot we can get in the short term. I think where we've wrapped our head around this is like if you look at people are looking at the relative stocks of what's going on in the natural gas sector. And I think what's the problem is we need to watch the flow. So if we look at the stock levels are at 80, 90% and people get confident about it. But what we need to look at is the daily flow, the changes in the flow, because what we have right now is even at 80, 90%, that's only good enough for 75% of 1 month in the winter. And now all of us are forecasting the weather. So I think the stimulus and the packages and all the things that are being put in place, price caps, rationing, they're good for a longer term story for the euro. Next year, we're generally pretty bullish. We don't think this is a full, long structural dollar cycle, but we're still kind of driven by these terms of trade shock. So I think what we're getting is confidence that things can recover next year. But we still need to get through the end of the Fed tightening cycle. We still need confirmation that inflation has peaked. We still need to know where terminal rate pricing lands, and we still need the global economy start to recover. So in the context of what we are expecting from the energy side is fiscal stimulus is good, but in the short term, more demand and less supply on the energy markets is still going to prop up inflation. So real rates are still going to continue to move against euro and sterling for the next 3 to 5 months until I'd say Q1 of next year.
So until we get more certainty, how much liquidity is there in some of these very deep FX markets that traditionally have been very much the tell for so many other markets?
Well, I still think there's a lot of depth and complexities going through. Volumes are pretty high on some of the standard G10 currencies. Is probably where you lose some interest is when you look at Norway and Sweden and some of the Scandinavian markets. They are trading very much like, or even worse than, emerging markets. Like if you look at something like the Mexican peso, the Brazilian real, they're trading off relatively important, strong fundamentals that are an interesting backdrop. Because if you would think the environment that we're in now, which is U.S. equities are outperforming, real rates in the U.S. have rocketed, especially at the 2-year level. And if we look at how Mexican peso is traded, it's trading as an interesting dynamic where global data prices are improving. People are starting to become more interested in carry. That's a question that we keep getting a lot. Like, when should we move back into emerging market carry? And the peso kind of captures that sweet spot. So the traditional currencies that people are watching are still kind of doing what they should. But it's really some of the, I would say the periphery ones, like the Norwegian krone and Sweden. Those currencies are almost impossible to trade right now.
Mark, just quickly, just to really tighten it up, if we get 50 and not 75 from this ECB, what does the euro do?
Right. So we're anticipating actually 50, and we think it's basically a coin toss. But the sequence is this. What's the terminal rate? We're expecting the ECB end at 2. So do you go 50, 50, 50 from here, or do you go 75, 50, and 25? We're expecting they go 50 now and try to maintain the same level of getting to a terminal rate of 2. Yeah. Euro is absolutely not going to like that. And so what we're anticipating is we're getting a little bit of a short squeeze here, fade the euro, and we are looking for a move over the next couple of months to 96 cents.
Mark McCormick, thank you, sir, of TD Securities, laying it out for you with a bit of crystal ball type stuff, looking out to next year. We'll hear from the ECB at 8:15 Eastern Time. We had a statement from Buckingham Palace just moments ago. I want to share that statement with you from the Palace. Following further evaluation this morning, the Queen's doctors are concerned for Her Majesty's health and have recommended that she remain under medical supervision. The Queen remains comfortable and at Balmoral. Balmoral, for those of you that don't know, the Scottish holiday home to the royal family. That statement follows news in the last 12 hours or so that the Queen had to postpone a meeting with senior government officials just yesterday, Tom, after a full day of activities with Boris Johnson visiting her and then, of course, Liz Truss. So, TK, that's the latest from the Palace this morning. That statement coming just moments ago.
A path on from 1953, and we'll have to watch it very, very carefully. No question about that.
Looking forward to catching up with Guy Johnson, I believe, in about 3 minutes or so, 5 minutes or so from London. And we'll get you all an update on the Queen's health from the UK. At the moment, futures unchanged on the S&P 500, on the Nasdaq 100 down about 0.1%. Yields down 5 basis points on a 10-year, 321.42. In around about 34 minutes' time, you'll hear from the ECB. It's a toss-up, a coin toss between 50 basis points and 75. We'll see how big that rate hike is. Then 30 minutes after that, you'll hear from President Lagarde herself in a news conference. And about halfway through the news conference, at some point, you'll hear from Chairman Powell. So a busy couple of hours coming up on Bloomberg TV and on Bloomberg Radio. Futures unchanged, live from New York. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The UK's new Prime Minister says there are no cost-free options to resolve the global energy crisis. Today, Liz Truss unveiled a sweeping package of measures to contain spiraling energy bills. It will cap the amount that consumers pay for natural gas and electricity, By one estimate, that could cost the government up to $230 billion. But officials say it will cut inflation by 4 to 5 percentage points. If economists surveyed by Bloomberg are correct, the ECB will join more than 40 central banks that are using outsized rate hikes to fight inflation. The ECB is expected today to raise rates by an unprecedented 3/4 of a percentage point. The rate decision is due at 8:15 New York time. ECB President Christine Lagarde will speak afterwards. U.S. Secretary of State Antony Blinken has made an unannounced trip to Ukraine. Blinken arrived in Kyiv today for meetings with Ukrainian officials. It's his third trip there since the war with Russia began in February. The Pentagon has sent Ukraine its most accurate artillery shell. That's according to budget documents that show the U.S. military is spending $92 million to replenish its stock. The Excalibur is a satellite-guided projectile that can hit within 7 feet of its target. Each round costs roughly $100,000. And there was just one major surprise at Apple's latest product unveiling. In one of the worst years of inflation in decades, well, the company is not raising prices. Apple introduced the new iPhone 14, new AirPods Pro earbuds, and new Apple Watch. The iPhone looks similar to the older version while getting an improved camera and also a satellite messaging feature. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
An update on the Queen's health from Buckingham Palace just moments ago. Here's the statement for you. Following further evaluation this morning, the Queen's doctors are concerned for Her Majesty's health and have recommended she remain under medical supervision. The Queen remains comfortable and at Balmoral. Balmoral, of course, the Scottish holiday home of the royal family. Already getting response from the British Prime Minister Liz Truss, who had this to say out on Twitter just moments ago. The whole country will be deeply concerned by the news from Buckingham Palace this lunchtime. My thoughts and the thoughts of the people across our United Kingdom are with Her Majesty the Queen, Tom, and her family at this time.
And we begin, after the photo yesterday, or 2 days ago, John, that we saw of the Queen greeting the Prime Minister, of course, also the former Prime Minister Johnson. John, your thoughts on that photo?
I think a lot of people saw that photo, Tom.
Yeah.
And thought that the Queen looked frail at 96 years old, perhaps unsurprising. Guy Johnson has the latest for us from London. Guy, walk me through how rare it is to get an update of this kind from the palace.
Extremely rare, John, and quite candid in some ways. Normally, the language used around the Queen's health is a little bit more opaque. I think this is, relative to what we would normally get, quite clear. They are concerned for her health. I think that should speak to exactly the situation that we find ourselves with here. The Queen has decided to stay at Balmoral over the last few weeks. Normally, she would have greeted Liz Truss and asked her to form a new government at Buckingham Palace. First time it's ever happened. That didn't happen. She's postponed a Privy Council meeting of senior ministers. She is clearly trying to, and her doctors are making this clear, that this is what she needs to do, to rest. And I think that's all we can say at this point. But John, to your point, I think this is a very candid comment from the doctors that look after her, the very good doctors that look after her. The medical care is second to none.
Guy, help our worldwide audience, including Morning in America, with how Prince Charles will respond to this news. Obviously, a family. He was at her coronation as a very, very young child. But how does Prince Charles, the Prince of Wales, respond to this news?
Tom, I remember you asking me exactly the same question when Prince Philip died last year. And I think probably the same answer holds true, and that is that this is his mother. They are very close. And as a result of which, I think that will be his first response. This is his mother. He will be devastated that she is as frail as she is. They have had a close working, personal, family relationship, and they are very, very close. So obviously, I think that will be his first response. Clearly, he will understand that he has a responsibility to the nation, and that is where I think the response this time round differs, Tom. This is the crown. This is the Queen. This is him taking over that crown and becoming king. And I think he will understand the weight of that and understand the responsibility that comes with it. So therefore, I think it is a different response. But I think primarily, first of all, this is his mother, but it is the crown. It is the Queen. He will become king. And therefore, I think the response is very different from Prince Charles this time round.
Guy, just to put this into perspective, Queen Elizabeth II has been queen since she was 25 years old. She is now 96 years old. She has invited Winston Churchill to be prime minister and just invited Liz Truss to be prime minister. This is someone who spans an entire history and many histories, people could argue, within the United Kingdom. Can you put into perspective, especially given her popularity, what this means for a nation that has seen her as a leader through so many generations?
Most people won't remember anything else. And as a result of which, Lisa, this is a huge wrench for the country. It is a massive wrench for the country. She has been totemic. She has been front and centre. She has been at the core of British life for so long that this will be a huge wrench. She has lived through and been monarch through a huge transformation in the UK status in the world. Coming out of the Second World War, through Suez, through the turbulence of the 70s, the 60s and the 70s. She has been steadfast through all of that. She has been the rock on which the British system has been founded. And removing that keystone is huge and will have a huge and profound effect on the way that Britain thinks about itself going forward. She has been central. She has been absolutely at the core of everything. And to remove her from that position, I think, will be a major, major change for the United Kingdom.
Guy, this is quite rightly going to dominate the news flow in the United Kingdom for the very least the next 24 hours and beyond, if things develop. Guy, is anyone going to be talking about what we heard from the Prime Minister in the last hour?
That's an interesting question, John. I think the cost of living squeeze this winter is going to be very difficult for the UK. And as a result of which, in some ways, the timing is not good. The UK has many challenges ahead. I think people will be relieved that Liz Truss has got this information out before this subsequent news surrounding the Queen has developed. And as a result of which, I think a lot of people in the UK will be breathing a sigh of relief that their energy bills will be limited throughout this winter and maybe into next as well. So in some ways, the sequencing, allowing that news to come out, I think is important. A lot of people will take that as a sigh of relief. But as you say, and I think as you allude to, John, I think a lot of people's attention will now refocus on what is happening at Balmoral.
Guy, thank you, sir. We'll catch up with you a little bit later. Bloomberg's Guy Johnson there on the latest. If you're just tuning in on Bloomberg TV and Radio, this was the statement from the palace we got in the last 20 minutes or so. Following further evaluation this morning, the Queen's doctors are concerned for Her Majesty's health and have recommended she remain under medical supervision. The Queen remains comfortable and at Balmoral. Balmoral, of course, the family home, the Scottish holiday home to the royal family. Liz Truss, who just 2 days ago invited to form a government by the Queen. Liz Truss had this to say: the whole country will be deeply concerned by the news from Buckingham Palace this lunchtime. My thoughts and the thoughts of people across our United Kingdom are with Her Majesty the Queen and her family at this time. As for her family, Tom, according to the latest reports in the UK at the moment, I understand Prince Charles and Camilla are at Balmoral to be with the Queen's side, and Prince William is travelling up to Scotland as well.
There'll be a lot of coverage on this, and I think the tradition, not that I'm an expert on this, John, but the tradition of the family, the House of Windsor, of being in Scotland speaks volumes. This goes far back to the Queen's mother, and I would just suggest the comfort there versus the drafty halls of Buckingham Palace has to be tantamount.
We'll stay on top of the news flow for you. Any updates, and we'll bring them to you. We need to gear up for an important couple of hours for financial markets, of course, and that's where the focus is going to be on this programme into the next hour with an ECB rate decision about 20 minutes away. Then after that, you'll hear from the chairman of the Federal Reserve, Jay Powell. He's going to have his own address a little bit later, at the same time that President Lagarde is delivering a news conference. So, Tom, here's the plan as far as I'm concerned on TV and radio. We get that decision at 8:15 Eastern Time. 30 minutes after that, we'll have a news conference with President Lagarde of the ECB. We'll carry that through the news conference until we hear from Chairman Powell, and then we'll pick up on Chairman Powell's comments, Tom, once they commence.
I have been at the Cato Institute where the chairman shows up, John, and it's always interesting. It is a different think tank. There should be some comments that are important.
And that's where the focus will be, with futures unchanged on the S&P 500, on the Nasdaq 100, down around about 0.1%. Live from New York City this morning, good morning to you all, with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. This is Bloomberg.
I think what's going on right now in Europe, frankly, is confusing.
Globally, you can see economies all around the world are slowing down.
The U.S. economy is in a much better spot. No, it's not a great spot, but it's in a much better spot than Europe.
The dollar is ending up as the safe haven of choice by default because there's all these issues in the rest of the world.
With the momentum here and what's going on in Europe, we're going to see the 75 basis point probably tightening from the ECB.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. An extraordinarily busy day with an ECB decision in 15 minutes. The Queen's illness noted in Scotland. But, John, now we focus on Christine Lagarde. 50 basis points or 75 basis points?
50 or 75, and Tom, if it's 50, if it's 75, we're still going to ask the same question. They're facing down the potential, the real potential of going into recession. Can they keep hiking into that, TK, when a lot of this comes down to the price of gas?
And they are not, John, one cohesive Brussels or one cohesive Frankfurt. There's a fractured Europe at the moment here. Which country are you going to follow most here as we see the press conference and the nuances of it?
So actually for me, Tom, it's within the executive board in Frankfurt. It's a split. It looks like a split between Philip Lane, the chief economist on the executive board, and Isabel Schnabel. Schnabel seems to be very, very keen on front-loading, going hard and being decisive. Philip Lane has taken a little bit more of a delicate approach in his recent communication, Tom. So I wonder how that debate takes shape in this news conference when President Lagarde has to try and represent some form of consensus on the committee.
And the consensus there goes back to the heritage of the ECB, John. I go back to Otmar Issing and all that I've done with him over the years, and of course Trichet of France with a different approach as well. Schnabel's a name many of our listeners and viewers don't know. She was a force at Jackson Hole.
By far one of the best communicators at the European Central Bank, Tom, by far. And we can all agree on that. The difference between this ECB and the ECB under Draghi is that the Bundesbank, Tom, is at the wheel. The Hawks are in charge on this one, and that's been a major change under Lagarde, particularly in the last couple of months. And let's face it, it's been a big change because inflation has seen a massive change in Europe over the last year.
And Lisa Abramowicz in charge as well as the price of this currency or that. And then there's the currency of this war, which is hydrocarbons, West Texas Intermediate nearing $79 a barrel.
The push-pull of demand destruction with supply destruction, with this idea that not only are you getting some constraints from the war that Russia has waged in Ukraine, but also with the idea that OPEC Plus marginally reduced some of their supply targets in response to the demand destruction, which takes center stage. And how do you achieve demand destruction if you're supporting the household expenses that have to do with energy, like a lot of European nations are trying to do?
Finally, dollar takes a break. John, let's get to the data check here so we can get to Alessio De Longus as we go 12 minutes to this ECB decision. John, there, Maria Tadeo in Frankfurt as well, I believe, in this hour. John, I'm going to go to Brent crude 88.41, distant from the 120 panic of weeks ago.
I love Maria. She takes a month off and comes back for the ECB rate decision.
I took a sabbatical too,
Only
John,
returns
yesterday.
For the news. You want to take a month off, Tom?
No, I took a day off. Leave me alone.
Unchanged on the S&P 500, on the Nasdaq 100. We're unchanged too. Leave you alone. You're the vacation police, not me. Euro dollar, unchanged, basically at parity, up about 0.1% on that currency pair. TK yields lower 4 or 5 basis points, 321.80. Big turnaround in crude yesterday, bouncing back just a little bit, up 0.6%. WTI 82.46.
To give you perspective on this important decision, we're thrilled. Scheduled Holger Schmieding will join us from Berenberg, and we wanted to get somebody just as astute before this announcement. Alessio De Longus joins us, Senior Portfolio Manager, Head of GTAA Solutions. He does that at Invesco. What will you look for? What is the nuance of the 8:15 announcements, not the press conference, but the series of Bloomberg headlines that come out?
Well, in my opinion, it's really the headline itself. It's really all about that 75 versus 50.
Nothing else really matters. It's
Nothing,
just a single.
Yes, because I think we are in a position where the ECB really has to keep up with the pace of tightening that is happening elsewhere, with the Bank of England, with the Fed, because ultimately, and we already started talking about it, it now becomes a currency war game potentially going the other way. If the ECB does not deliver 75, the weakness in the euro versus the dollar or other currencies will actually negate any policy tightening efforts, because a weakening euro, true, euro-dollar does not matter as much to the ECB, but it does matter when your problem is inflation on the energy front, which is priced in dollars, right? So the ECB needs to deliver 75 basis points to stay on par with the hawkish rhetoric of the Fed and the Bank of England. That's, I think, what really matters. And to your earlier discussion with John, I think that there is actually an opportunity here for the doves to concede, because at the moment, with where inflation is, there's really no argument to be had. But the doves may have the upper end again, say, 2 quarters from now, when further hikes are far more challenging, when growth will be weaker.
Well, Alessio, let's talk about the forecasts we should get in the news conference from President Lagarde. Is this central bank prepared, do you think, to forecast a recession?
Great question. I think they'll probably shy away of a negative GDP growth in 2023, but it will be very close to zero, maybe south of 0.5%. What I think they will do, though, is show that even out in 2024, both headline and core will be at 2 or above 2, which is already a big concession, in my opinion. I think that's the most important metric at the moment.
So right now we're looking at what you were talking about with respect to the doves possibly taking a little bit more control in a couple of quarters. Does that make you potentially bullish on certain European assets down the line, because you could see that pivot first by the ECB?
The timing on that is very, very particular. We are at that inflection point, and it may be a matter of a couple of quarters or a year. But we are now at those extreme valuations relative to U.S. assets on basically every asset class. Obviously, let's not get started on relative equity performance, but even when you look at rate differentials on the short and the long end, very extreme spreads. And on the euro, the conditions for the euro to continue weakening here are in place, even with the 75 basis points, regardless of what will happen today. We have those two forces that are supporting the dollar. Global growth disappointing, below consensus, that's dollar positive. And yield differentials, both on a rate of change basis and the level, support the dollar in an incredible way. But that pivot, when we are at the very last steps of these tightening cycles, that pivot will be very, very powerful. The next recovery, which could be just less than a year away, will be led by non-U.S. assets, will be led by the euro, in my opinion.
This is fascinating, especially because right now people are piling into the dollar, as you just said, and continue to move away from all non-U.S. assets. So how violent will this shift be, and what will the catalyst be? How do you get ahead of it at a time where it's really hard to predict what Vladimir Putin's going to do, what prices of oil are going to do, or anything else with Chinese lockdowns, et cetera?
Well, we know that currency valuations in particular can really overshoot and undershoot fundamentals. And I don't want to draw a direct analogy with the Plaza Accord of 1985, but we are potentially in one of those situations where the momentum in favor of the dollar, because there is no alternative, because of the geopolitical risk, becomes so strong that some form of intervention, some form of coordinated intervention will have to take place. By the way, that happened also in 2000, 99, 2000, 2001, when the dollar was at incredible strength. And we had this similar rotation, this dominance from U.S. assets into the following phase, which was non-U.S. assets led. So I think some level of policy coordination will have to take place if we continue with this trend.
Alessio, I struggle with this. And I'm not here to say whether it happens or not, just to say that I struggle with it because the Treasury, this Fed, this country right now needs a strong currency. And if Japan wants one, then they can do something about it themselves, can't they? Tomorrow.
True. Every country, this is the paradox compared to 10 years ago, that now currency wars are actually in reverse, where everybody needs a bit of a stronger currency to deal with the inflation problem. The challenge, yes, Japan typically has intervened. The challenge is that it's a very frowned upon. There is this agreement, this gentleman's agreement, that meaningful currency interventions have to be coordinated and have to be discussed, because we don't want to go back to that environment in 2010, 2013, where we were doing competitive devaluations. In this case, we would be doing competitive reappreciations of those currencies.
Alessio, wonderful to catch up. We can't squeeze in Napoli. We'll have to do that another time. But I know you're excited, and I was happy too. Alessio De Longis there of Invesco. Tom, any policy decision involves a trade-off. And Japan has decided right now that it's more important, the BOJ has at least, to maintain a cap in its bond market in JGPs. The consequence of that at the moment, quite clearly, is a much, much weaker currency. If they believe the trade-off is not worth the squeeze, then tomorrow morning they can do something about it. If they remove the cap and the BOJ did that, Tom, what do you think would happen to JGBs?
Jump condition.
What would happen to the Japanese yen almost immediately?
Immediately.
Now, if you're the US policymaker, if you're in the Treasury right now, and you hear Japan complaining about the currency being too weak, what are you going to do? Don't you just call them back and just say, well, we're doing what we're doing, and you can do something about it if you want to?
We've done this for years. John, I think to set this up for people, there's nominal GDP, what actually is earned, and then you take away the inflation component, and you have real GDP or inflation-adjusted GDP. Each culture and society worries about one or three of those. The weightings vary, and it's a collegial debate that's out there. Japan is fixated on constructing an inflation, of avoiding deflation, and they do that at the expense of nominal GDP, and the answer is it's a zombie economy. There's no other way.
And at the expense of a weaker currency, seemingly, as well, Lisa.
Well, that's the reason why the currency really hasn't responded to the verbal intervention, right? I mean, maybe marginally on the edges, but people say if you want to do something, you very well can, and this isn't going to work. We're not going to blink because you just say, we don't like it.
In the last currency war, and it was currency war in reverse, remember? It's different to what we've got right now. I remember the authorities in New Zealand talked about turning up to a war with a pea shooter. And I think we've got to face the fact that the Bank of Japan has its own bazooka. It's just using it to do something different to everybody else. And the outcome is a weaker currency. Got an ECB rate decision about 4 minutes away. We'll break that down for you from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. If economists surveyed by Bloomberg are correct, the ECB will join more than 40 central banks that are using outsized rate hikes to fight inflation. The ECB is expected to raise rates today by an unprecedented 0.75 percentage point. The rate decision is due in a few minutes from now. ECB President Christine Lagarde will speak afterwards. The UK's new Prime Minister says there are no cost-free options to resolve the global energy crisis. Today, Liz Truss unveiled a sweeping package of measures to contain spiraling energy bills. It will cap the amount that consumers pay for natural gas and electricity. By one estimate, that could cost the government up to $230 billion. But officials say it will cut inflation by 4 to 5 percentage points. Meanwhile, doctors for Queen Elizabeth II say they are concerned for her health. A statement from Buckingham Palace says the British monarch is comfortable at Balmoral in Scotland. Queen Elizabeth is 96 years old. She was seen earlier this week meeting with the new prime minister. And President Biden is holding back on a decision to scrap any Trump-era tariffs on China imports. Earlier this summer, the president had signed off on a new exclusion process for exemptions from tariffs on manufacturing materials imported from China. Bloomberg's learned the administration is studying ways to help businesses seeking relief. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Certainly when you look at Europe, yeah, the US is in a much better spot. As I say, not great on its own in absolute terms, but in relative terms, yes, it's hard to make a case for Europe over the US in any form right now.
That was Lee Ferriger State Street just yesterday going into an ECB rate decision. That decision is 1 minute away. With Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Going into it, futures positive, about 0.1% on the S&P 500. On the Nasdaq 100, unchanged. Euro dollar, Tom, 1.0018.
Right.
We're positive about 0.1%.
Pro tip, follow John Ferro. The dynamic here that matters is to watch the outlier, which is John, Italy. It'll be interesting to see how Italy paper moves here.
And that spread going into this decision, about 227 basis points. Lisa, 50 or 75. We're 30 seconds away.
And whether or not it's going to matter, right? A lot of people saying the consensus is 75. You are seeing a bit of euro strengthening ahead of this. Can it stick regardless of what the ECB does in the face of some of these energy problems?
And Bramo, a news conference as well. Yeah. We're looking for some forecasts, and I think it's important to recognise this. We're all talking about a recession, aren't we? In Europe. It's not there yet. Might be in one now. Haven't seen the data yet. Will the ECB actually forecast one in that news conference in 30 minutes?
And if they don't, what does it mean for their credibility at a time when everybody else seems to be forecasting one?
Seconds away from that rate decision, we are looking for 75. Most people, though, think it's a coin toss between 50 basis points or 75 from this ECB. The decision moments away. Leaks out seconds late. This is not unusual. There it is. 75 basis points from the ECB. The depot rate goes from 0 to 75. The marginal lending facility goes to 150. The main refinancing rate goes to 125. So that is a 75 basis point hike from the European Central Bank. The reaction in the market looks like this on euro dollar. Slightly positive by 0.1%. Euro dollar right now 1.0018. I was talking about the spread between Italy and Germany at the moment. That's about 227. So Lisa, 50 or 75? It's 75.
And the question is going to be what they signal going forward, as a lot of people are already pricing in another 75 basis point of rate hikes through the remainder of the year. What does this mean for assets? You are seeing a bit of a pop, as you said, to the euro. But how much do they buffer this with some recognition of the pain that is being conferred on the euro region as a result of the higher energy prices, as well as suddenly the fact that negative yields, zero rates, has absolutely evaporated?
Working through the statement, we're getting some forecasts here. Looking ahead, the ECB staff have significantly revised up their inflation projections, and inflation is now expected to average 8.1% in 2022, 5.5% in 2023, and 2.3% in 2024. On the growth outlook, after a rebound in the first half of 22, recent data point to a substantial slowdown in euro area economic growth, with the economy expected to stagnate later in the year and in the first quarter of 23. They go on to say, very high energy prices are reducing the purchasing power of people's incomes, and although supply bottlenecks are easing, they're still constraining economic activity. In addition, the adverse geopolitical situation, especially Russia's unjustified aggression towards Ukraine, is weighing on the confidence of business and consumers. The outlook is reflected in the latest staff projections for economic growth, which have been revised down markedly for the remainder of the current year and throughout 23. I can give you that outlook now. They look for the economy to grow by 3.1% in 2022, 0.9% in 23, 1.9% in 2024. It's a 75 basis point hike today. They're not forecasting a recession right now, and they expect to raise interest rates again over the next few meetings. They're going to go meeting by meeting. But, Tom, I think if you get any criticism of the decision today, it might not be on the policy call. It may well be on the forecasts, because these forecasts are for growth. They are not for a recession as far as I can see.
Well, they're forecasts and they're very political as well. Let's remember there's no statement in there on a war in Ukraine, which has a little bit to this. At least I haven't seen that as well. John, I love the elegance of getting away from data dependency and forward guidance, where they just gracefully say, there will be a meeting-by-meeting approach. They do it more elegantly than we do in math-centric Washington.
And this data is moving quickly. I believe we've got Maria Tadeo standing by in Frankfurt. It's been a while, Maria. Typically, I'd spend some time welcoming you back, but we've got some news to cover. Go through the headlines for us.
Yes, and Jonathan, 75 basis points, it was the obvious choice, but it was not a given, because the debate around 75 or 50 basis points had really heated up in the days prior. Remember, some in the Governing Council were concerned about the idea of a full-blown energy crisis, potentially hiking aggressively in the face of potentially a recession, which they don't refer to here. They talk about stagflation, but nonetheless, to me, what it shows is that the hawks have it. It's really the hawks that control the Governing Council now, and they really did feel at this point there is a window to hike. The European Central Bank credibility is on the line here. You had to take, or have to take, decisive action here.
Maria, who are the hawks besides the obvious Bundesbank and the people of Germany? Who joins them this morning?
I mean, we've seen this. It's the Dutch. It's also the Austrians. I guess we'll have to find it really to see this press conference whether this was unanimous or not, because there could be a surprise here where some governing councils who usually may be on the dovish side also feel like it was a good idea to front load a lot of this, especially because if you get to December and that recession does manifest, or you go into this big energy crisis, you could not be or should not be hiking at that point. So this may also be a question about front loading now that you have that window. I think the other key takeaway for me will be any references to Italy. We talk a lot about Germany, but Italy is also a country that is very exposed to that energy story, but also has a change in government, and it's unclear what that is going to look like.
Maria, what does it do for ECB credibility, the fact that they do not forecast recession, that they do forecast growth, as John was pointing out?
Look, I think when you look at this outside of the European Union, it probably seems diluted. It probably seems stupid that they're not operating in the reality that many investors are. But when I talk to European officials, they do always repeat one thing, is that there's two scenarios here. One is the most stress, in which you enter a recession, in which there is a serious energy crisis, in which, of course, you enter into serious problems with the economy. But they also say there could be a less stressful scenario in which you do not have a cold winter, in which you do see demand going down because it's expensive, because people switch things off, because they don't want to pay for a hefty bill. There's also potentially to come tomorrow measures from the European Commission that could help all of this. They talk about liquidity for companies too. They also talk about intervene in the market so that you make a separation between gas and electricity. They also say they're well advanced on the storage story. So for many European officials, they do believe that there could be a scenario in which you're just able by a stretch to get through the winter without a recession.
Maria, I can take the opportunity now. We missed you. It's good to have you back. Maria Tadeo there from Frankfurt, Germany, on the ECB rate decision. TK, it is 75. And going into this news conference, the euro slightly weaker, 99.94.
John, I launched my chart of the year today, and it is a different 75 basis points in Europe. I would suggest, John, and I defer to you on this with your years of experience in Frankfurt, this is an easy lift for them. The next lift will be far more profound.
Gets harder and harder. And Tom, especially if the economy, growth, does not evolve in the way they anticipate. They're talking about maybe things, Tom, dropping off to what we might be able to call stagnation. Let's face it, we're talking about more than that in Europe right now, Tom. We're talking recession.
Futures flat in America, the VIX 24.95 off what we saw yesterday. DXY under a 110 level, a bit weaker dollar, but some real huge blinking on the Bloomberg terminal this morning. Vasilios Giannakis joins us now of Citigroup. Vasilios, real simple, what is the closest attribute or thing that matters to the ECB after this announcement? Is it GDP? Is it the price of hydrocarbons? Is it what Mr. Putin does? What's the variable that matters now for Lagarde?
Well, the ECB's mandate, the ECB's merit is quite clear, and that is about inflation. So strictly speaking, it should definitely be the outlook for price growth, the outlook for inflation. And I think today's meeting had two interesting things. First of all, it highlighted the 75 basis points hike as front-loading. And secondly, it kept on reiterating that meeting-by-meeting approach. And in my view, given the fact that inflation is running at 9% currently, way above the ECB's target, which is slightly below the 2%, it doesn't give me confidence that that inflation is taking priority over everything else. So in that sense, and I think that's the big takeaway from the statement so far, of course, we'll see what the press conference brings us, is that there is still an enormous weight on the growth outlook. And that weight could potentially go up or down depending on how growth pans out. But again, this is not a central bank that communicates that inflation is the top priority, as it should be, and we will find it and we will keep at it, like the Fed said.
Given that, Vasilios, do you expect the euro to decline more significantly versus the dollar because that, you believe, will ultimately be the message from this rate decision?
Look, I think today's statement so far, absent any major surprises from the press conference, I don't think it's positive. It's supportive of the euro. But outside the ECB, there also the elephant in the room is global growth, and that's the elephant in the room of the euro. As long as global growth remains muted, very muted, and as long as China keeps going on with a zero COVID policy and the unwillingness to stimulate meaningfully, it will not bail out global growth. And as long as this does not happen, it is very unlikely that euro is going to find any support. So long story short, yes, I'd be selling the euro.
Vasilios Giannakis. Vasilios, great to catch up off the back of this ECB decision. So much more to discuss with you over time. Joining us out of City, it's 75 from the ECB, and I can tell you in about 20 minutes' time, we'll hear from the President of the European Central Bank, Christine Lagarde. Shortly thereafter, we'll hear from Chairman Powell at a separate event. So this is what we'll do at about 8:45 Eastern. That news conference will begin. We'll take that for you. Then when Chairman Powell starts to talk, in an address, a conversation at about 9:10 Eastern time. We'll pick up on that as well. Futures up by about 0.1% on the S&P, on the Nasdaq 100. We are basically unchanged. Tom, off the back of this, euro dollar firmer by maybe 0.1%. It's going to all be about the news conference in 20 minutes' time.
And this is where you go to euro sterling, euro yen, and the others to see what the real tip point is, the balance point. And I would suggest, John, it's really off euro yen, a fractional move here that we see on euro.
Front loading, Bramo. It's 75. What's next?
Yeah, well, that's the question. And is this front loading, meaning that they're going to stop and pause sooner than likely? In other words, are they going to end up with the Alessio De Longus idea that they could possibly reverse course and have a very powerful rally in a couple months' time? It seems very far away when they're prioritizing.
Remember when we used to call the forecast from the Fed aspirational? Yeah. Do you think those GDP forecasts are aspirational?
That's what we just heard about the idea that they're not prioritizing inflation over all else. There still is a growth component.
Up next, Holger Schmieding of Berenberg from New York. This is Bloomberg. Live from New York City this morning. Good morning with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures are just about positive on the S&P 500. On the S&P 500, we are higher by 0.02%. On the Nasdaq 100, we are negative by 0.07%. You'll hear from the ECB President Christine Lagarde in about 15 minutes' time. Then after that, you'll hear from Chairman Powell. We can hear from Mike McKee, which is so much better. Morning, Mike.
I wish I had a whole lot to tell you here, but we have very small change in jobless claims. They go down 222,000. It's a decrease of 6,000 from the previous week's level. Of course, that's revised to 232,000, revised down from 232 to 228. So it looks like at this point we are still seeing strength in the U.S. labor market. 1,473,000 people getting ongoing claims, so people still getting jobs. That is the good news in the United States. It pales kind of in comparison with what's going on around the rest of the world.
Sure, but
it's a data point.
It pushes back against the gloom, though, doesn't it, Mike?
It does push. It does push back against the gloom. The latest economic data in the U.S. has been relatively good, but the Fed has been much more hawkish, sort of unitarily so over the last week, which is why pretty much the focus now in the markets has turned to 75 basis points, and we'll see what Jay Powell has to say about that later this morning.
TK, a bit more fuel for those hawks, looking at claims at 222,000.
Michael McKee, 4 weeks in a row down. It gets us back to early summer. What is a level in your head where Michael McKee goes, oh?
I don't know that there's a level because we're in a unique environment where there are so many job openings at this point. I think it would be a continuing rise that didn't really show signs of peaking that would start to get people's attention. This is a signal that things are relatively good, at least as far as corporations are concerned.
Right now, what's the threshold for them to move away from a 75 basis point rate hike? I'm talking about the Federal Reserve at a time when everybody else has gone hawkish, and this is the summer of 75.
Yeah, I mean, you look at the ECB, the most surprising thing to me in their announcement was that they don't see a recession. in train, and everybody else seems to. So if they don't see a recession and they're going 75, what's the Fed going to do? Because they don't want a recession either. I think that 75 is pretty much baked in. Even if we get a decline in the CPI next week, which is what is forecast on a month-over-month basis, CPI Tuesday, and if we get that, then it's still probably going to be 75. Because
you said it, TK.
As Jim Bullard says, if you're going to get somewhere faster. There's no reason to wait. Yeah.
Front-loading Wednesday.
Mike McKee, thank you. What's Thursday then, Tom?
I haven't figured out.
PPI.
That's retail sales.
Thursday.
Retail sales this Thursday. We have CPI, PPI, and retail sales all in a row just to keep you guys on your toes.
Jobless claims Thursday.
Futures down 1/10 on the S&P. On the Nasdaq, we're down 0.2%. Euro dollar, just checking in on the euro for you. We are at just about parity, positive 1/10, Tom. The news conference, 12 minutes away.
Early morning in America, we make light of it with terrific news flow today, but these are serious matters, and particularly with the war in Ukraine pushed up against all the other conversations. And the conversations of Europe are complex, which is why to go from Alessio De Longus to Holger Schmieding, he is chief economist at Berenberg, is our great privilege this morning. Careful conversation on these moments. What will you listen for from Christine Lagarde after she's decided there's no recession ahead?
Well, I will listen, of course, to three things. First of all, what does she say about the future path of interest rates? Does she go beyond this meeting-by-meeting approach? Any hint whether the next move could be 50, 25, or another big 75? Again, that's the one key thing. Second, I'd love an explanation why they don't yet see a recession. We expect a significant recession in coming months. And third, any comments on the future of their asset purchase programs? More precisely, any comments on could there be some quantitative tightening, some roll-off of expiring bonds from the ECB's balance sheet in the future? Or what do they think, and what do they think about current yield levels? Are they anywhere close to needing this TPI new intervention program in favor of Italy? Probably they are not, but any comment on that would, of course, be most interesting.
Holger Schmieding, what is the power of Ottmar Issing, of Axel Weber, of a Bundesbank culture back to World War II, certainly back to the Reformation of Europe coming out of World War II? What is the Germanic power at the ECB this morning?
Well, say the hawkish viewpoint on rates did prevail. I wouldn't quite call it Germanic power. It is just that we've seen such a surge in inflation that the European Central Bank, like the US Fed, has decided it needs to be seen as fighting inflation. And we'll hear whether this was a consensus. I suppose this was a near unanimous consensus that the ECB at the Council needs to do something significant. And the quid pro quo may have been that the ECB does not, judging by the statement, edge closer towards quantitative tightening. So that's something which the doves may have gotten out of it. But we'll hear at the press conference any comments about that.
Holger, would you call this front-loading or just incredibly delayed?
Well, this is front-loading relative to ECB standards. They haven't done 75 basis points before. That is quite a bit, especially in a situation where many indicators suggest that the economy is heading not just for stagnation, but probably for worse, a recession, which over time will, of course, on its own dampen inflationary pressures.
A lot of journalists listening to your response, Holger, and trying to work out the appropriate question to ask the president in this news conference. Just why isn't she forecasting a recession? Why is the staff of the ECB not forecasting one?
That's a good question. I'd love to listen to that answer, and I will try. And I'm sure one of your colleagues will pose that question at the news conference. My impression is that, the ECB is typically a bit slow in revising these forecasts. They have now meeting after forecast round after forecast round been forced to make significant changes. And secondly, they may be a bit under the impression of the very good data for the second quarter, above trend growth in the Eurozone, and what was in Southern Europe probably a very good tourist season over the summer. But if we still hang in Q3, despite all the bad news about energy, that actually means that the risk that Q4, from a good, still decent Q3, that Q4 could be deeply negative, that risk is actually rising rather than falling. And I'd love to hear the ECB explain why that should be stagnation rather than actual recession.
That's the benefit of the doubt version of things. Then you've got the Vasilios Giannakis take on it, which made him somewhat bearish on the euro, all things being equal, saying it highlights how this is an ECB that still is prioritizing growth in tandem with just fighting inflation, which makes him somewhat concerned. Do you get the same message from the fact that they did not forecast recession, that they're still forecasting growth despite very much higher rates and despite some of the incredible economic pain facing the region?
Well, I don't quite get that impression. I would focus more on it's been 75 basis points. It's been 50 basis points in the meeting before, more than the ECB had indicated beforehand, especially a few months ago. And the ECB has vowed to raise rates further. So I don't think that this decision today exhibits any sort of hesitancy on doing what it takes to tackle inflation. The real question over here is whether anything the ECB can do really will have a significant impact on inflation, as the European inflation, a bit unlike the US inflation, the European inflation is largely a matter, well, of Putin's war against Ukraine, of the sky-high wholesale prices for gas, for electricity, and not the result of any excess consumer demand over here, or not yet, at least the result of any excess wage pressures.
Is there a pivot point threshold that you're looking for? In other words, is there a point of pain in the economy that might be big enough for the ECB to reverse course?
Well, the ECB probably won't reverse course, but I think that come the beginning of next year, with probably the fourth quarter having been significantly negative and the outlook likely to be that in the first quarter of next year, the recession will remain pretty deep, that then the ECB will likely go on hold. So the ECB may now raise rates, the main refi rate, to say 2% by December, with a chance it could be a bit above that. But next year, with the economy in a probably quite significant recession, early next year and late this year already, next year I think the ECB will then stay on hold and let the recession and the base effects of inflation do the job of bringing annual inflation down again quite a lot over the course of next year, from probably early spring onwards.
Holger, Christine Lagarde will parse today the difference between Brent crude and natural gas. What is Berenberg's research here on the separation of a much better statistic for a barrel of Brent crude versus the agony of what we see in natural gas right now?
Well, over here, these various sources of energy are very disconnected, in the sense that Brent crude is, of course, one major element of a largely global market for crude oil. And in the global market, we've seen a bit of, well, price easing for oil in response to, well, recession, or at least recession fears. Whereas gas prices, extremely volatile, are up to the calculus, can Europe make it through the winter or not? We are currently modestly optimistic that Europe can make it through the winter without having to ration gas to industry. But the price for that is we in Europe are filling up our storage facilities quite nicely, but we are paying through the nose for it. So natural gas and to some extent electricity reflect the European drive to basically prepare for the winter at almost any cost, whereas oil is a global price, more or less.
Holger, thank you. It's important to get your perspective going into that news conference following that monetary policy decision. Holger Schmieding there of Berenberg. If you're just tuning in, that news conference is about 4 minutes away. At 8:45 Eastern Time, we'll hear from President Lagarde of the European Central Bank. Then at about 9:10 Eastern Time, at a separate event, you'll hear from Chairman Powell. So we'll take the news conference on Bloomberg TV and Radio. Then we'll gradually, eventually, shift towards Chairman Powell. About 30 minutes after, we heard from the ECB, and they delivered a 75 basis point rate hike and signaled there may well be more to come. The outlook, well, it's never good. It's never good if you have to upgrade your inflation outlook and cut your growth forecast. So here's the outlook for inflation from the ECB. And I'll quote the team, the Governing Council, directly from their statement. As the current drivers of inflation fade over time and the normalization of monetary policy works its way through to the economy and price setting, inflation will come down. But here's the but. Looking ahead, ECB staff have significantly revised up their inflation projections, and inflation is now expected to average 8.1% in 2022, 5.5% in 2023, and 2.3% in 2024. We talked about the forecasts on growth and question as to whether they are so-called aspirational. Are they aspirational forecasts, considering that the forecasts that I see on growth right now do not include a recession? They say this: after a rebound in the first half of 2022, recent data points to a substantial slowdown in Eurozone economic growth, with the economy expected to stagnate later in the year and in the first quarter of 2023. They talk about the energy backdrop. They say very high energy prices are reducing the purchasing power of people's incomes, and although supply bottlenecks are easing, they're still constraining economic activity. The forecasts from the staff at the ECB now look like this. They expect the economy to grow by 3.1% in 2022, 0.9% in 2023, and 1.9% in 2024. And I imagine those growth forecasts will be questioned in this news conference about 2 minutes away. From Frankfurt, outside the ECB, just before this news conference begins, is Maria Tadeo. Maria, can you run me through where you think the line of questioning will begin with this ECB president?
Well, I think number one is, and you alluded to this, isn't this too optimistic? We're entering in a winter that potentially for some looks almost apocalyptic for the European economy. Again, this goes back to what I mentioned earlier, which is behind the scenes, there's still officials in both Frankfurt but also Brussels who believe they can avoid that recession scenario, who still say we have not played our cards here. We can still deal with the gas situation, put a cap on it. We can separate electricity to demand destruction. That will be key. They're aiming for 10%. If that happens, perhaps they're able to wing it. They also talk about liquidity for all of these companies, fiscal support. A lot of this coming together could mean that just by a stretch, they're able to get through this winter without a recession. A lot of this, by the way, will depend on something that Christine Lagarde cannot control, and that is the weather. Is this going to be a cold winter? Will it be a mild winter? So I think you can call this wishful thinking, and I guess, you can blame investors for saying this is wishful thinking, but for them is one of the options that's on the table, and they don't want to talk down the economy further.
Biggest hike ever for the ECB. Maria, thank you. That news conference with President Lagarde starting imminently in Frankfurt. When it begins, we'll head over to it. Lisa, do you think it's aspirational? Dare I say, I could be on the edge of being rude here, are those forecasts laughable for the European economy?
A lot of people, including some bank CEOs, would probably say yes, that they are laughable to just assume there will not be a recession as a base case, even as you hike rates into weakening growth, given the fact that they're still projecting inflation rates miles away from where the central bank needs to see them. Interesting to see how they explain that.
Tom, you've seen a lot of decisions over the years, plenty of forecasts. What do you make of this decision and these forecasts?
Well, to me, the decision is the backdrop against their economic might and their productivity, given the huge uncertainty of a war. And as I said earlier, John, to me, the decision is the Fed has acted, and the Fed is searching in the gloom, and maybe we'll see that at the Cato Institute today, towards some form of neutrality, some form of we're there. I don't think we have a clue where there is for the ECB.
And Lisa, to be fair for this ECB and the leadership of the European Central Bank, so much of this is out of their control. Gas prices, a war, a policy decision that is out of their hands. It's up to European governments to decide what they're going to do, something radically different from the UK. We'll get something different from Germany, from Italy. Can we get a big agreement at the European level to do something? Is it about curtailing demand? So much of these things that have huge implications for them and their decision are totally out of their hands.
This is a really difficult situation for the ECB, which is one reason why I personally am wondering whether tomorrow's meeting of finance ministers, energy finance ministers in Europe is going to be more important for markets than this rate decision, because right now the ECB is looking into the same cloudy mess that the rest of us are doing.
I couldn't agree with you more. When we look at the outlook for the ECB right now, I'm less interested in their forecasts and more interested in the price of gas next year. And if they could have that price right now, then imagine how much more confident they'd be about what they have to do.
Although, will they actually then project that they're going to get some sort of growth still, or would it be the opposite, right? I mean, if you have to think about the pain that would be required to do this, we see this in the UK, and the reality that we're seeing over there, why is it not being reflected by any other central bank, even though to a lesser degree other banks are facing the same outlook?
We can head over to the ECB chief right now. Let's listen in.
Good break. So, today the Vice President and I welcome you to our press conference. The Governing Council today decided to raise the 3 key ECB interest rates by 75 basis points. This major step frontloads the transition from the prevailing highly accommodative level of policy rates towards levels that will ensure the timely return of inflation to our 2% medium-term target. Based on our current assessment, over the next several meetings, we expect to raise interest rates further to dampen demand and guard against the risk of a persistent upward shift in inflation expectations. We will regularly re-evaluate our policy path in light of incoming information and the evolving inflation outlook. Our future policy rate decisions will continue to be data-dependent and follow a meeting-by-meeting approach. We took today's decision and expect to raise interest rates further because inflation remains far too high and is likely to stay above our target for an extended period. According to Eurostat's flash estimate, inflation reached 9.5% in August. Soaring inflation and food prices, demand pressures in some sectors owing to the reopening of the economy, and supply bottlenecks are still driving up inflation. Price pressures have continued to strengthen and broaden across the economy, and inflation may rise further in the near term. As the current drivers of inflation fade over time, and the normalization of our monetary policy works its way through the economy and price setting, inflation will come down. Looking ahead, ECB staff have significantly revised up their inflation projections, and inflation is now expected to average 8.1% in 22, 5.5% in 23, and 2.3% in 24. After a rebound in the first half of 22, recent data point to a substantial slowdown in euro area economic growth, with the economy expected to stagnate later in the year and in the first quarter of 23. Very high energy prices are reducing the purchasing power of people's incomes, and although supply bottlenecks are easing, they are still constraining economic activity. In addition, the adverse geopolitical situation, especially Russia's unjustified aggression towards Ukraine, is weighing on the confidence of businesses and consumers. This outlook is reflected in the latest staff projections for economic growth, which have been revised down markedly for the remainder of the current year and throughout 23. Staff now expects the economy to grow by 3.1% in 22, 0.9% in 23, and 1.9% in 24. The lasting vulnerabilities caused by the pandemic still pose a risk to the smooth transmission of our monetary policy. The Governing Council will therefore continue applying flexibility in reinvesting redemptions coming due in the Pandemic Emergency Purchase Programme portfolio, with a view to countering risk to the transmission mechanism related to the pandemic. The decisions taken up today are set out in a press release available on our website. A separate technical press release on the remuneration of government deposits will be published at 3:45. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. The euro area economy grew by 0.8% in the second quarter of 22, mainly owing to strong consumer spending on contact-intensive services as a result of the lifting of pandemic-related restrictions. Over the summer, as people traveled more, countries with large tourism sectors benefited especially. At the same time, businesses suffered from high energy costs and continued supply bottlenecks, although the latter have been gradually easing. While buoyant tourism has been supporting economic growth during the third quarter, we expect the economy to slow down substantially over the remainder of this year. There are four main reasons behind this. First, high inflation is dampening spending and production throughout the economy. And these headwinds are reinforced by gas supply disruptions. Second, the strong rebound in demand for services that came with the reopening of the economy will lose steam in the coming months. Third, the weakening in global demand, also in the context of tighter monetary policy in many major economies, and the worsening terms of trade will mean less support for the euro area economy. And fourth, uncertainty remains high and confidence is falling sharply. At the same time, the labour market has remained robust, supporting economic activity. Employment increased by more than 600,000 people in the second quarter of 2022, and the unemployment rate stood at a historical low of 6.6% in July. Total hours worked increased further by 0.6% in the second quarter of 22 and have surpassed their pre-pandemic levels. Looking ahead, the slowing economy is likely to lead to some increase in the unemployment rate. Fiscal support measures to cushion the impact of higher energy prices should be temporary and targeted at the most vulnerable households and firms to limit the risk of fueling inflationary pressures, to enhance the efficiency of public spending, and to preserve debt sustainability. Structural policies should aim at raising the euro area's growth potential and supporting its resilience. Inflation rose further to 9.1% in August. Energy price inflation remained extremely elevated at 38.3%, and it was again the dominant component of overall inflation. Market-based indicators suggest that in the near term, oil prices will moderate, while wholesale gas prices will stay extraordinarily high. Food price inflation also rose in August to 10.6%, partly reflecting higher input costs related to energy, disruptions of trade in food commodities, and adverse weather conditions. While supply bottlenecks have been easing, these continue to gradually feed through to consumer prices and are putting upward pressure on inflation, as is recovering demand in the services sector. The depreciation of the euro has also added to the build-up of inflationary pressures. Price pressures are spreading across more and more sectors, in part owing to the impact of high energy costs across the whole economy. Accordingly, measures of underlying inflation remain at elevated levels, and the latest staff projections see inflation excluding food and energy reaching 3.9% in 22, 3.4% in 23, and 2.3% in 24. Resilient labour markets and some catch-up to compensate for higher inflation are likely to support growth in wages. At the same time, incoming data and recent wage agreements indicate that wage dynamics remain contained overall. Most measures of longer-term inflation expectations currently stand at around 2%, although recent above-target revisions to some indicators warrant continued monitoring. Let's turn to our risk assessment now. In the context of the slowing global economy, risks to growth are primarily on the downside, in particular in the near term. As reflected in the downside scenario in the staff projections, a long-lasting war in Ukraine remains a significant risk to growth, especially if firms and households faced rationing of energy supplies. In such a situation, confidence could deteriorate further and supply-side constraints could worsen again. Energy and food costs could also remain persistently higher than expected. A further deterioration in the global economic outlook could be an additional drag on euro area external demand. The risks to the inflation outlook are primarily on the upside. In the same way as for growth, the major risk in the short term is a further disruption of energy supplies. Over the medium term, inflation may turn out to be higher than expected because of a persistent worsening of the production capacity of the euro area economy, further increases in energy and food prices, a rise in inflation expectations above our targets, or higher than anticipated wage rises. However, if energy costs were to decline or demand were to weaken over the medium term, it would lower pressures on prices. Let's look at the financial and monetary conditions now. Market interest rates have increased in anticipation of further monetary policy normalization in response to the inflation outlook. Credit to firms has become more expensive over recent months, and bank lending rates for households now stand at their highest levels in more than 5 years. In terms of volumes, bank lending to firms has so far remained strong, in part reflecting the need to finance high production costs and inventory building. Mortgage lending to households is moderating because of tightening credit standards, rising borrowing costs, and weak consumer confidence. Summing up, we raised the 3 key ECB interest rates